of years, and the growth outlook is a bit weaker, including because of actually an aging workforce in the euro area as well, compared to the US, where we've seen some remarkable strength in the last couple of years.
Claire, as you might expect, some conversation at this side of the world, in the United States, about the election taking place at the end of the year, and some conversation about former President Donald Trump's plans if he secures another term in the White House. There is discussion of a blanket 60% plus tariff on Chinese imports. Have you modelled what that would do to inflation in America through 2025 and beyond? What is the experience of, say, 2018, when we started to ramp up tariffs then?
We haven't modelled any particular scenarios in this space, but what we do is we look at a lot of the detailed data on trade, and certainly what we've seen, and it's a concerning trend for the global economy, is a reduction in sort of trade integration. You know, for a long period, we saw trade increasing, we saw integration of global value chains, and that delivered, you know, wider choices to consumers. It delivered lower prices, and you know, we have seen that trend reversed for a whole range of reasons, and you know, that comes at a cost in terms of productivity and in terms of pricing for people. So you know, we would like to see you know, trade continuing and you know, increased trade on a rules-based fair system.
Claire, just to build on that, though, there is this question of how you model out economic forecasts based on policies that are massively divergent depending on who's in power. How much are you trying to even get your head around what the potential downside would be to global trade given one scenario versus another? Are you making those models?
Well, what we do is we take current plans and current administration's plans for when we're constructing all of our forecasts around the world, and so we base them on those expectations.
Hey, Claire, appreciate the clarity. Always do. It's good to hear from you. Claire Lombardetti there of the OECD. Anne-Marie, I want to come to you on this. I don't see how you can have an outlook for 2025 right now on inflation, on growth, with the clarity, without the clarity of what policy is going to look like in the White House. If we are seriously having a conversation about the difference between maintaining the current stance on China, which is yes, tariffs, but not increasing them, that's option one. And option two, going forward with a blanket 60% plus tariff on Chinese imports, you are going to have a radically different outlook, surely, on both growth and inflation.
And not just 60% blanket tariffs on China, also a potential 10% tariff wall, invisible wall as they described it in the Trump campaign, this reporting of all imports into the United States. That is very different than what we potentially would see in another Biden administration.
Every outlook, Bramo, for 2025 needs that asterisk. It needs it. It needs that caveat. It's like, these are our basic assumptions, just a continuation of what we've already seen coming out of the White House. Because once you start putting in different alternatives, I think you get a very different outlook.
What did Lori Calvasina say earlier this morning? That basically every outlook has to have about a 60% conviction right now. But what's the range? How big is the range? What I would want to see is models showing one scenario or another and showing the differential there. Are people even starting to draw those up?
Also, how much are the tariffs actually, if Trump were to become president again, actually be put in place? Or are they just being used now as leverage? So when he goes to the table, as he likes to say, he likes to have leverage, and we've seen him use tariffs as leverage in the past.
I do think this is whipping around Chinese equity markets. I really do. It's early days, I know, but some of the moves we've seen in China, and there are plenty of reasons for those moves, but some of the moves have been pretty wild.
Well, how much of this also has to do just with a lot of U.S. businesses withdrawing a lot of their activity or trying to, you know, move where the manufacturing happens? This is only will accelerate it. If you're a business trying to come up with your plan, even regardless of what actually ends up getting passed, how do you have any conviction to go invest in China given this uncertainty with the political sphere?
I think in some cases, you've just got to wait. That's the latest on that front. More in a moment from Terry Haynes of Pangea Policy. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Russian President Vladimir Putin is expected to visit Turkey next week. It would be his first trip to a NATO member country since he ordered the invasion of Ukraine 2 years ago. Meetings with Turkish President Tayyip Erdogan are expected to focus on energy cooperation and security in Syria. The war in Ukraine will likely also be on the agenda. Putin's trips abroad have been limited due to the risk of possible arrest on a warrant for alleged war crimes from the International Criminal Court. Harvard added 2 top business executives to its governing board. KKR co-CEO Joseph Bay and former Merck CEO Kenneth Frazier were elected Sunday as the university continues to face intense criticism from alumni, lawmakers, and faculty. Harvard's interim president, Alan Garber, said, quote, "They share a commitment to academic freedom, inclusion, and the pursuit of excellence in Harvard's mission of teaching and research." Taylor Swift just broke another record, winning Album of the Year for the 4th time at the Grammys. Swift had previously been tied with Frank Sinatra, Paul Simon, and Stevie Wonder for the most wins in the category. The Grammys also were a big night for female acts, who swept all 4 of the top prizes. That's your Bloomberg Brief. John?
Yahara, thank you. That list of artists, absolutely ridiculous. Up next on the program, the Senate's bipartisan bill unveiled.
I am really proud and pleased to announce that Democrats and Republicans in the Senate have come to an agreement on the bipartisan supplemental bill tonight.
Is that agreement dead on arrival? That question gets answered up next.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Equities this morning slightly softer, lower, negative, down 0.2% on the S&P 500. Bond yields higher on a 10-year, up 6 basis points, almost 4.1% on a 2-year, 443. Yields up by 6 or 7 basis points. Under surveillance this morning, the Senate's bipartisan bill unveiled.
I am really proud and pleased to announce that Democrats and Republicans in the Senate have come to an agreement on the bipartisan supplemental bill tonight. Ukraine would be run over by Putin if we don't get aid in this bill. Israel needs to defend itself against Hamas with the aid in this bill. We fix the border problem in this bill.
Do we? That's the question. Here's the latest. After months of closed-door negotiations, the Senate unveiling a $118 billion bipartisan deal to secure the U.S.-Mexico border and release aid to Ukraine and Israel. The bill touted by President Biden and senators on both sides of the aisle, facing major opposition from Republicans in the House, where Anne-Marie, it's headed this week.
That's right. House Speaker Mike Johnson says it is dead on arrival. He took to Twitter last night and says this bill's even worse than we expected and won't come close to ending the border catastrophe the president has created. As the lead Democrat negotiator proclaimed, under this legislation, quote, the border never closes. This bill reaches the House. John, dead on arrival.
Terry Haynes, founder of Pangea Policy, joins us some more. Terry, let's pick up on Anne-Marie's quote. Is it truly dead on arrival?
Oh, no, not at all. Not even a little bit. Not even mostly dead. My favorite movie, The Princess Bride, would say. you have to understand what the House is talking about. What they're saying is it's dead on arrival because they prefer their own bill, the famous H.R. 2, which passed the House last year. And so what will end up happening is if the Senate can pass its own bill, and I'll give it, I don't want to go against Lori Calvasina or Lisa here this morning, so I'll give it 60% that they do that. And they do that, and then they end up conferencing, and the House can make its case that what it wants is better than what the Senate already has. The momentum here is much towards political and substantive, is much towards a strong bill. Certainly Biden wants that. Certainly Republicans want it. And as Anne Marie pointed out earlier, this is their big chance. So I think it's likelier than not that all this ends up happening.
But Terry, do you think House Republicans will capitulate to the former president who doesn't want to see a deal in this election year?
I think Trump is far less important than in this sense than most people give credit for. I always look at motivations, and as I've just said, I think the motivations here are for Biden and for Republicans alike are very strong. But the fundamental motivation of a Republican member of Congress or any member of Congress is to get reelected. Secondly, they're most interested in maintaining or flipping to a majority, and after that, we'll start talking about the president. So if they can end up with a bill that is, from a House perspective, they can end up with a bill that's a little bit stronger than the Senate bill, and they can take credit for making it so, they'll do that in a heartbeat, sure.
Probably safer for them to get it done sooner rather than later, given the fact that the election's in November. What's the timeline you see for the supplemental?
Oh, well, work expands to fill the time allotted, and these folks have already shown a great deal of flexibility in that. Just look at how long it's taken them to, not come up with a final spending bill, at least 4 or 5 months now. But I think this probably goes until mid-March, and then they probably wrap up a lot of this stuff. That seems to be the window they think is the one that they want. So I'll take them at their word.
Terry, I am wondering if Trump vehemently opposes this and he's leading in the polls, how much does that really curtail its possibility of getting passed?
I don't think a lot, frankly, because what will end up happening is that the Trump rhetoric and the House Republican and conservative Republican reality of wanting a bill that's stronger than what the Senate has already proposed and making Biden sign that, I think is a very important matter for them. And I think it's something that they want. And that's something Trump, frankly, will be interested in taking credit for. So in the end, those interests dovetail, I think. I'd look for Biden and centrist Democrats to try to shut down the left on this too, which they haven't done yet.
What do you think of Mike Johnson's possibility of staying the speaker through the remainder of the election cycle, given that he is trying to essentially herd cats?
Well, I think Johnson probably does end up staying. The reason for that, I think, is firstly, the Republicans can ill afford another circus. Even after all this, they hold more confidence with the public than Biden does on issues like the economy, for example, immigration being another. And I think they'll want to do that. Secondly, I've always looked at the cat herding as a matter of getting something going on the border that's strong and that's defensible, in which Johnson can then use to say, okay, now let's we've gotten our big win on that. Let's wrap up spending with some modest haircuts, but only modest, not even the 1% that they want, and call it a day on that. They'll all grumble, but they'll go forward.
Terry, you started the conversation by saying Speaker Johnson is calling this dead on arrival because it's not the H.R. 2 that House Republicans want. So what do the Republicans in the House want to see potentially in conference with senators to then be able to sign their name on this bill?
Well, ideally, I'll give you two. Ideally, one obvious. They want H.R. 2, and it's the House's job to get out over their skis and go too far with the idea generally, the idea that the Senate reins things back in conference. Outside of all that, the thing I would look at the most is the idea that the border is still somehow porous in some way, and you've already seen House Republican rhetoric focus on this. The idea that the border can be shut down for a period of time while things get together, I think is very important to them, and that's something that I heard Senator Sinema, independent from Arizona, talk about to some extent yesterday. They're certainly going to want to shore that up before they finalize anything.
Terry, I've got 45 seconds left. I wanted to ask you this all morning. The Super Bowl, massive television audience. Why would the president turn down a pre-Super Bowl interview?
That's a very good question. And not one I can answer. It's something that has become a standard appearance, and one in which the absence, frankly, is I think inexplainable, inexplicable, however you want it.
Bizarre. Terry, thank you, sir. Terry Haynes of Pangaea Policy. The administration complains about how reporters cover the economy. You're coming off the back of a jobs report which saw more than 300,000 jobs, 2 years of unemployment below 4%. Mr. President, how are you preparing for the game? 353,000 different ways, sir. Enjoy the match. I mean, you can literally say anything you want and squeeze in whatever you want to say about the labor market.
And 115 million viewers were watching the Super Bowl last year, and that was without Taylor Swift. So when I asked the campaign over the weekend, they say it's early in the cycle, political exhaustion. But to your point, John, they have a good story to tell next week.
I think the comms director said that they don't know how many eyes are on the screen, and are they making chili and putting beer in the cooler?
Focus on the show.
What does that even mean? Coming up next, Ed Yardeni of Yardeni Research, Sally Krawczyk of Alavest, and SocGen's Zabadra Rajappa.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world, and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Max 7 has been the one driving S&P earnings, and they're going to continue to do that this year.
Looking at Meta, looking at the Magnificent Seven, they're in a different stratosphere.
When we look at the Magnificent Seven, it's a story of relative winners and losers.
There's going to be winners and losers. Make sure you know what you're buying.
That's been our view all along, which means quality stocks will continue to do better.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Once again, kicking off the trading week at all-time highs on the S&P 500. Live from New York City this morning. Good morning for our audience worldwide. Alongside Lisa Abramowitz, together with Anne-Marie Hordern, I'm Jonathan Ferro. This is Bloomberg Surveillance. Your equity market pulling back by 0.2% on the S&P 500. In many ways, this week is a hangover of last week. We need to talk about the Federal Reserve and that blowout jobs report. I think we have to begin, though, with that record surge in market cap from Meta. Lisa, almost $200 billion. Just amazing.
When you see a $1 trillion company surge by 20% in one day, it raises this question: is this strength or is this fragility for a market that is hinged more and more on a small cadre of big tech names?
And did that flatter the post-jobs market reaction? If you strip out Meta, strip out Amazon, was good news truly good news?
How interest rate sensitive really is this market? Meta is in a league of its own, in its own stratosphere, as we heard just there. But there is a question here: is there a lot of rate sensitivity under the hood when you've got the Russell 2000 really struggling, 73 components, 73 members, really not hanging in there, 73%? Really showing losses as a result of some of the interest rate increases.
I'm sure you thought about this over the weekend. The prospect of derailing the soft landing narrative sees Andrew Holmhorst was soft landing after Friday's data. How close are we to things changing? Just a drip feed of further decent information, because that wasn't a one-off in terms of an upside surprise. We've had plenty of them over the last few weeks.
I think that the theme for me is 60% conviction, because I saw notes saying that this gave people more conviction of the soft landing and the strength in the U.S. economy. And then you had other people coming out and saying it actually makes things look worse and more fragile, and the potential for a hard landing. Stuart Kaiser, good news is good news. He was saying, pop quiz, what do you think it's going to be? Better or worse to buy stocks? Better, I mean, you get all sorts of views.
Well, let's talk about low conviction. Low conviction down in Washington, D.C. How much conviction do you have that the text of that bill becomes reality later this week?
Well, Terry Haynes is putting it at 60%, so let's just go with his conviction at the moment, Jonathan. But this bill that the Senate has finally released the text of, that we've been hearing about for months, trying to see what was in it, $118 billion on the top line, something for everyone in this. $60 billion aid for Ukraine, $20 billion for the border, $10 billion for Israel. Now, Terry Haynes says it's dead on arrival for Speaker Johnson because it's not H.R. 2. But if they're going to go to conference and hammer it out, potentially there's something that can get changed in it that gets a little bit more warmer for those House Republicans.
We talked about it in the previous hour, so let's go back into it. Is this one potentially dead on arrival because it doesn't go far enough, or because the former president wants to run on this issue in the election?
Substance versus politics. The issue with the politics, that the closer we get to November, Trump will be breathing down these House Republicans' necks to not do it. NBC poll this weekend: Biden's deficit versus Trump on handling immigration and the border, greater than 30 points. This is a huge election issue.
Next hour, Henrietta Trays of Vader Partners. Look out for that conversation later on Bloomberg Surveillance. Here's the price action for you on the S&P 500. Equity futures negative here by 0.2%, pulling back just a little bit. A lift in the bond market in terms of yield. Treasuries lower, yields up. Lisa, surprising for some, given that we didn't really get new information from Chairman Powell over the weekend, and yet here we are, yields higher by 7 basis points on a 2-year, up on a 10-year by 6 or 7 basis points again.
It showed that Powell, though, had perhaps a wait-and-see approach even before the blowout jobs numbers. So if he was not talking about a March rate cut before that, certainly after that, the chances were almost de minimis. And then you have a question of, okay, well, then what would his response be to concerns that maybe they're getting it a little bit wrong with longer-term inflation?
That data really reinforced the message from last Wednesday and again over the weekend. The euro negative here by 0.3%. Dollar stronger on that currency pair, 107.52. Coming up this hour, Ed Yardeni of Yardeni Research on the earnings-powered equity rally, Subhadra Japa of SocGen on the Fed's path forward, and CFRA's Alexander Yoakum on fears of another regional banking crisis following Last year's stress, last spring. Here we go again, maybe. We begin with our top story, a blowout jobs report and Meta's surge, sending equities to fresh record highs. Ed Yardeni, president of Yardeni Research, thinks stocks have more room to run. He writes this: our earnings projections results in our S&P 500 price index targets of 5,400 by year-end 24, 6,000 by year-end 25. Just 8 stocks account for more than 1/4 of the S&P 500's capitalization. Our forecasts assume that the mega cap 8 will continue to inflate the index's earnings, revenues, profit margin, and valuation. Ed Yardeni joins us now. Ed, let's get straight into it, buddy, and it's great to catch up. The contribution of that handful, those handful of stocks, what has the contribution been so far, Ed, to earnings over the last quarter, the last year?
Well, the mega cap 8, as I like to focus on, accounted for something like 27% currently of the market cap of the S&P 500, 18% of the forward revenues, earnings, earnings, I should say, of the S&P 500, and something in the neighborhood of around 10% of revenues. So they're big.
And the numbers are absolutely huge. Is there any reason to believe this rally broadens out anytime soon?
I think there's lots of reasons to believe that. The economy is doing quite well. I think the Fed has clearly signaled they're done raising interest rates, and they at some point may be lowering interest rates. And so and of course they're extremely cheap. The S&P 400 and 600 are something like 14, 15 on a forward PE basis. The S&P 500 is 17, and the mega cap 8 are close to 30.
Lori Cavacino is saying that she's got about 60% conviction with all of her calls, increasing her forecast to 5,500 for year-end on the S&P 500. Do you have more conviction with your calls, and do you have a higher target?
Well, I have more conviction because the market's moving faster in that direction. I've been thinking 5,400 by year-end, but we may get there sooner. Same thing happened to me last year. I was thinking 4,600 by year-end, and we got there by July of last year. So this market is extremely powerful to the upside, obviously.
Have you upgraded your forecast yet? Are you thinking about it?
I don't think I have to at this point. I think I've been an outlier with 5,400 for this year, and I think I'm still an outlier. I don't know that too many people are talking about next year, but I've certainly signaled that I'm remain bullish through next year by talking about 6,000 by the end of next year.
Do you know how this works?
The economy.
Some people just naturally gravitate towards pessimism. I'm not naming anybody this morning, Ed, but after the jobs report of Friday, people are asking this question, and I'd like your response to it. Why don't you believe that numbers like Friday derails the hopes and dreams of a soft landing?
I think the pessimists have really been missing one important variable, and that's productivity. The productivity numbers during the last 3 quarters of last year were extraordinarily strong. I think we're in the early stages of a productivity boom, as confirmed by recent data, and I think that continues. Look, that was a strong employment number, but people just completely ignored the fact that average weekly hours was down 0.6%, offsetting the 0.2% increase in payroll employment. And when you add in that wages were up 0.6%, in nominal terms, wages and salaries seem to be on course to be up only 0.2% during last month. So the number wasn't quite as strong as people thought.
Yeah, and there was plenty of research over the weekend really diving in and questioning just how much the revisions and seasonalities would perhaps upend some of that strength. Ed, I am curious, though, about interest rate sensitivity in the stock market. So many people talked about how that really would reduce multiples if interest rates stayed high. And here we are looking at an economy that's incredibly resilient, in some cases even accelerating. At what point does that challenge valuations purely if interest rates stay at this level for a much longer period of time?
Well, I've been looking at the history of valuation multiples, and there is a widespread perception that they should be inversely related to interest rates and inflation. When inflation and interest rates go up, valuation multiples should go down. But I think what it really turns out to be is that when interest rates go up, it increases the chances of a recession, and then recessions do from time to time actually happen, and that's when the valuation multiples really get crushed. So it's not just rising interest rates, it's rising interest rates causing a recession. That isn't happening this time, and quite the opposite. It seems that the economy is remarkably resilient. Look, clearly the Fed has tightened monetary policy dramatically over the past 2 years, 525 basis points in the Fed funds rate. But I think they've also normalized. Interest rates are back to where they should be. and the economy can handle it, and that's great for earnings.
Is this early cycle still, Ed, in your view?
Well, it's early cycle, but you know, it's moving pretty quick. Clearly, in the market moving so fast in this bull run.
Neil Dutter agrees with you, and I'm sure you've seen his research over at Renmac. This is what he wrote. I see weak growth in total hours worked, but continued solid growth in the economy. This implies strong growth in labour productivity, which in turn means unit labour costs are under control. That's a good backdrop for corporate earnings. Are you making a productivity call here, Ed? Is that ultimately the essence of it?
Well, that's been my call since the beginning of the decade. I've been talking about the roaring 2020s as a possible scenario for this decade. Obviously, there's alternatives, like a repeat of the 1970s, even a repeat of the 1990s. But I give a 60% probability to this being the roaring 2020s, with productivity making a big comeback. Right now, it increased 2.7% year over year last year, which is very good. I mean, the average increase in productivity per year is 2%, and I think we're going to remain above that through the end of the decade. And as you said, unit labor costs have come down. They're down right around 2%, which is highly correlated with the CPI. So things are going really well for the economy.
Going really well for you as well, sir. Appreciate the update, as always. Thank you. Ed Yardeni of Yardeni Research. Bramo, S&P 500 price target, 5,400 year-end, 6,000 year-end 25.
He also is talking about the Magnificent Eight, or the Mega Cap 8, and what I'm curious about is if his prognostication comes to pass, that it will continue to account for about 25 to 30% of the overall weighting of the index. That alone could drive some of these returns. That, I think, is a controversial thesis at a time of lofty valuations, but something that people are considering.
The earnings contribution of those names has been phenomenal.
Totally.
Just absolutely phenomenal. Equity futures right now negative by 0.2% on the S&P 500. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Former President Donald Trump said he's considering a plan to impose a flat tariff of more than 60% on Chinese goods if elected. The comments signal an increasingly hawkish tone against the top supplier of goods to the U.S. Trump rejected criticism that actions would start a trade war. The U.S. has been China's biggest export market for more than 20 years, including over $500 billion in exports in 2022. McDonald's fourth quarter sales missed investor expectations as growth decelerated, hurt in part by the war in the Middle East. Same-store sales rose 3.4% in the period. That's the slowest rate since 2020. Revenue was also shy of estimates. McDonald's became a target for boycotts after the war broke out over its perceived stance on the conflict, as well as its status as one of the most recognized American brands. Fans in Hong Kong expressed disappointment after superstar Lionel Messi was left on the bench for the entirety of Inter Miami's 4-1 friendly win over a Hong Kong team. Tickets for the match sold out within an hour, with the Argentine World Cup winner the star attraction. Messi has a hamstring strain, so he didn't play, leaving fans upset. That's your Bloomberg Brief. John?
Yahara, thank you. If he's injured, it's understandable, right? But can you imagine paying up big time for those tickets?
I mean, honestly, this seems to be the way that things are going. How long until we get economic reports about, inflation from some of this stuff? I'm just saying.
Didn't we get that with Taylor Swift?
I just think we're going to get it again.
You think we get that from the Super Bowl?
I think that we're going to get that, and I think we're going to get that from the World Cup.
Hong Kong officials, the government requested to see him and asked why was he on the bench. This isn't just the fans. You have officials weighing in, being like, what's going on here?
You're blaming the outlook for 2026 CPI on the World Cup.
100%.
Okay. I mean, I don't think you're wrong.
I think it's going to really raise. It's going to just generate a lot of economic activity, inflation on all goods, hotel
in New
prices.
Jersey, specifically.
Or New York City, tri-state area.
Up next on the program, Powell throwing cold water on a March rate cut.
I think it's not likely that this committee will reach that level of confidence in time for the March meeting, which is in 7 weeks.
That conversation is coming up next, live from New York City this morning. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York City, equity futures on the S&P 500, just a little bit softer on the S&P. We're down by 0.16%. Yields are higher by 7 basis points, almost 4.1% on a US 10-year. The dollar stronger, the euro 107.52 on that currency pair, negative by 0.3%. Under surveillance this morning, Powell throwing cold water on a March rate cut.
I think it's not likely that this committee will reach that level of confidence in time for the March meeting, which is in 7 weeks. Almost all of the 19 participants who sit around this table believe that it will be appropriate in their most likely case for us to cut the federal funds rate this year. We just want to see more good data along those lines. It doesn't need to be better than what we've seen or even as good. It just needs to be good. And so we do expect to see that.
Here's the latest this morning. Fed Chair Jay Powell saying he doesn't expect to drastically change the central bank's 2024 rate forecast. Fed speak picking up this week with Bostic and Goolsbee today, followed by Mester, Kashgari, Collins and Harker tomorrow. Is that enough for you? Joining us around the table, Sally Krawcheck, the CEO and co-founder of Ellevest, a digital financial advisor, joins us now. Hello, Sally. Good to see you.
Good morning. Good
Let's
to be
get into
here.
your personal view first. You are bullish, constructive, optimistic almost.
For my personal view. So first of all, Ellevest, digital advisor, yes. Wealth management company also.
Cool.
Funded by, founded by, built for investing and investing through women. So I'm going to bring the woman's point of view here today. Yes, I am personally bullish. Doesn't particularly matter. But I do think what we've learned, by the way, I thought watching Jerome Powell last night, it's hard not to watch that individual and say, boy, I have confidence in him. And yes, maybe it's not March, maybe it's June, maybe it's a little later. But my personal bullishness, I seem to learn again and again, don't fight the Fed. Don't fight the Fed, right? The Fed took on the subprime crisis and won, took on the pandemic and won, took on Silicon Valley Bank and won, tightened last year, 2 years ago, and the market went down. Don't fight the Fed. They are very powerful. And if the rates are going to be going down, I'm personally feeling bullish. Doesn't affect our asset allocation at Ellevest at all, by the way.
Well, okay, so let's talk about that. Is there sort of the similar kind of bullishness underpinning certainly your clients' views, but also some of the asset allocations that you have currently?
Yeah. Well, when we do our asset allocation, we look at long-term returns that we're expecting, and they're terrific, right? The equity markets, if you go back to the early 1900s, tend to go up about 10% a year. Balanced portfolio 6%. It compounds, right? So it's hard not to be bullish over the long term. And what we're seeing with our women is they are indeed investing, often for impact. And we should talk about that because, of course, there's the blowback for impact. But the great thing about these women is they also stay the course. We've seen the research, and we now are seeing it proven at Ellevest, that they don't freak out when markets are tough. They really stay the course. And as a result, women outperform men when they invest. And that's true at the professional level as well as at the individual level.
Just dealing with the next sort of year before we get to the long-term view and some of what you're talking about, as someone who has been very powerful in a number of banks, I'm wondering how concerned you are just about credit creation at this point. The fact that, yes, rates are going to come down, but there's a real question, especially with certain constraints on bank balance sheets, commercial real estate, how much some of these firms can keep lending. Yeah. Does that sort of keep you up at night at all?
Well, what I have been worried about is, with Silicon Valley Bank, our Lehman or our Bear Stearns, right? Was it, the shoe that dropped that, the impact of rising interest rates on these banks, and particularly the regional banks, has been felt? and we can heal and move on, or is that the beginning of sort of a longer-term issue? And I think the jury is still out on that, though certainly every day that passes and something doesn't happen is a bullish signal.
As somebody, though, has understood just the long and variable lags, certainly through credit creation, what are you watching to understand whether there is something more pernicious under the hood just with respect to withdrawing some of the capital?
Yeah, we're not. I mean, again, at Ellevest, we invest for the longer term, not for these shifts and tactical changes. So we look at what do we view the longer term returns of the stock and bond markets as being, as opposed to what's going to happen this day or that day or even over the next year.
When you're looking at long term, what sectors are you most excited about?
All of them. All of them.
Well,
I mean, think about it. When you're investing in the markets, you're investing in the U.S. economy, in the global economy. And what these economies have shown is over reasonable periods of time, they tend towards growth, right? And so, we have a diversified portfolio that has access to all of them. Again, what we're seeing that may be different from a more typical investing firm is our women tend to be looking for impact. They tend to understand that we are all impact investors, that every dollar we invest or every dollar we spend, and by the way, women are responsible for 80 to 85% of consumer spending. So if we're going to talk about are we going into a recession, it's going to be the women who put us into a recession who keep us out. But what they recognize is their dollar has meaning and their dollar has impact, and they're looking not to give up a financial return at all, but they are looking for what is my impact in addition to my financial return.
So when you say impact, what do you define impact as?
Oh, so many ways we can go at this, right? Whether it's ESG, impact investing, whether it's gender lens investing, what is the dollar not being invested in and what is it being invested in, right? Is it being invested for environmental reasons, whether that's, I want to be out of companies that are going to suffer from global warming, or I want to be in companies that are actually having a positive role in fighting global warming. But it can also be gender lens, right? Am I investing in diverse leadership teams? Our women tend to care about that quite a bit.
We're heading into what some people would say the political silly season. We're going toward the election, and a lot of some of the impact investing has been highly politicized. How are you feeling? How is that playing out in terms of what counts as impact and sort of how you define some of these things?
Well, you see in New Hampshire, there are folks there who are trying to make impact investing or ESG investing illegal. And not a little bit illegal, felony illegal, go to jail illegal. Which, hello, I'm not supposed to, as an investor, take governance into account when I'm making an investment. I'm not supposed to take diversity of the leadership team into account. By the way, when the research has shown that diversity in the leadership team can drive superior performance, that there are very few things that you can say, oh, this correlates to a great leadership team for a company, but diversity is one of them. And I'm not supposed to take that into account. So we are indeed heading into sort of a funky moment. But let me tell you, as money goes more and more to women, because we should talk about the great wealth transfer, which is beginning to happen, and women want to invest more for impact, that can be a fundamental shift and a fundamental change.
Have you felt more dissent within the ranks, sort of along political lines?
No, we have not. We hear it from others. Oh my gosh, over here at XYZ investing company, we're getting some backlash against ESG. For us, where, the majority of our clients are women, we are not hearing backlash. We're hearing, I don't want to give up a financial return, but I also don't want to give up an impact return.
Sally, it's great to have you with us. Going to stick with us and pleased to say thank you. Sally Krawcheck of Ellevest, sticking with us. If you are just joining us, your equity market looks like this on the S&P 500, negative by 0.1%. Treasury yields are a little bit higher through the curve, the 2-year and to the 30-year. The 10-year right now is higher by 6 or 7 basis points, 4.08%. Chairman Powell on message, Elisa, a repeat of the message from Wednesday. That message taking on extra power after the payrolls Friday story.
Especially because some people had sort of dismissed it as an off-the-cuff, response to a reporter saying, yeah, March doesn't seem likely, rather than something that was in the statement. Something else that he said, it was a pretty wide-ranging conversation, including the deficit. And he was saying it was not sustainable, and he was talking about that. I thought he was very sort of political without being political.
Did he comment on European politics in the same way that the ECB president commented on US politics, no?
Extensive discussion of Olaf Scholz. No, he didn't do that.
I sensed he might not go there. Coming up in just a moment, the brilliant Subhadra Japa, the head of US rate strategy at SocGen, on the Fed's rate cut path from here. It feels like we got a dose of ice-cold water from Chairman Powell on the March rate cut calls. And based on what we've heard, Lisa, so far from Bank of America, was it Goldman too, and Barclays, all three who are looking for March rate cuts, has to push back those calls deeper into the year.
Right now, if you just look at where markets are pricing at, an 18% chance of a March rate cut, which I guess is only 18% chance just in case something happens in terms of really negative data. Actually, now it's 17%. It's going down as we speak from more than 50% last week.
People are waking up.
Yeah, maybe that's the case.
On Friday, we were talking about what would it take to bring back in the rate cut call for March. I wonder now, what would it take to get the rate hike calls going again? I imagine a few more prints like the one we got on Friday. More still to come from New York City this morning. Good morning to you all. Equity futures just a little bit softer. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Live from New York City, kicking off a brand new trading week. Your equity market pulling back just a little bit on the S&P 500, down a touch by 0.16% after 4 weeks of gains on the S&P. And Lisa, after closing at all-time highs on Friday.
With pretty narrow leadership, with one leadership, one name, Meta, which accounted for a significant portion of the overall gain. And that's all I can say, is that at a certain point, we have to look at the broadening out, or do we? Or can this sort of be sustainable for the longer term?
This goes back to what you and I have talked about all morning. Did that distort the story around good news being good news for the equity market? You strip it all out and look at the Russell, the small caps, not so good.
73% down on the day. So it doesn't seem like it's necessarily, lifting tides, lift all boats, considering the fact that these smaller boats are not being lifted. When does that change? I don't know. Honestly, anyone who's coming with conviction, I don't know, they should check with Lori Calvasino. She'll say, you should put 60% on that.
Lori's one of the best. Let's switch up the board and get to the bond market. 2-year, 10-year, 30-year. Treasuries look like this. How much conviction have you got on this right now? Yields up by 7 basis points, 4.4346 on a 2-year. 10-year north of 4% again, up 6 or 7 basis points, 4.0886% on a 10-year. If you push this through foreign exchange, you do have a move in the FX market. The dollar's stronger. The euro's weaker here. The euro, 107.57. Lisa, that's a break of 108 in the last couple of sessions.
I mean, what we're talking about here is divergence, ongoing divergence with the U.S. economy being stronger and the European region being weaker. But now there's a real question of whether the ECB will have to cut rates before the Fed. We were discounting that before. It's kind of coming back to the fore.
Yeah, the jobs data in Europe does not look like the jobs data in America, based on what we saw on Friday. That's the price action. Under surveillance this morning, Iranian-backed Houthi rebels vowing to respond to US and British-led airstrikes over the weekend. The strikes targeting 13 locations in Yemen were part of an effort to end the militant group's attacks on commercial ships at the Red Sea. It was the biggest barrage since the original Allied attacks on January 11th. MH, what is different about these attacks, and what does it change?
Well, there's more of them, and as we spoke to Norman Rule about, it's the fact that they're trying to degrade Iranian proxy's ability. But I was struck by Jake Sullivan's tone over the weekend. In one way, he said there's going to be this sustained response, but at the same time, it's not going to be an open-ended military campaign. So the White House is really trying to walk this line of responding, although Norm Rule said it was more of a defense, but they want to respond, but they don't want the conflict to spread.
The surprise for all of us around the table is waking up again on a Monday morning after strikes over the weekend, looking at crude and seeing it down. WTI and Brent this morning.
Again, I continue to wonder where oil prices would be if there was no hostilities right now in the Middle East. How low would oil prices actually be? Because some investors are obviously pricing in risk, given how important the Gulf of Aden and the Red Sea is.
Elisa, it's kind of amazing. 72 on WTI. Brent crude, 77. This has been going on now for more than 3 months.
Okay, not to quote you, but to quote you, does price sort of determine narrative? And that's what I keep wondering, because how many stories have we been reading about how actually OPEC Plus is supplying more oil than previously thought, demand isn't quite as great, the U.S. is pumping more, it's just a supply-driven story. All of a sudden we get a little more conflict, all of a sudden it's going to be a real issue. So I do wonder how much it's just people not betting on something that hasn't played out every time there's geopolitical risk.
Also, Saudi Arabia has a capacity for 12 million barrels a day. They're at 9. So if something were to happen, the market knows they're ready to turn on the taps, and they actually can. They're not like some countries that it takes a while to ramp up. Saudi Arabia wants to turn on the taps, they can do it pretty quickly.
There's a big cushion there. Let's turn to the next story, Anne-Marie. Busy weekend on Capitol Hill. On Saturday, the House unveiling a standalone $17 billion Israel aid package without any support for Ukraine. Speaker Mike Johnson saying the U.S. needs to get aid to Israel quickly, and there is no time to consider a package combining aid to Ukraine and Israel with U.S. border security provisions. The Senate, however, reaching a $118 billion bipartisan deal on Ukraine, and that includes $20 billion for border security. Each chamber expecting to vote on their bill this week. Anne-Marie, what goes through, what doesn't, and what is dead on arrival?
I think a lot of this doesn't go through as is. So put the Israel standalone bill to one side. First off, the House Freedom Caucus comes out and says it's not paid for, so we don't want it. Democrats are going to say we likely want something more encompassing. Look what the Senate's doing. But I go back to what Terry Haynes says, 60% chance you have this broader supplemental that goes through. And when you say to him, but Speaker Johnson says this is dead on arrival, he says that current bill is dead on arrival because the House want to flex their HR 2. They want remain in Mexico. But at some point, this is going to go down to a conference, and there is potential. But of course, we know potentially the politics make it a little bit more complicated.
That's the latest in Washington. If you're flying this morning, turn down the volume. You done that? Okay. Boeing shares falling in the pre-market. The company announcing it found more mistakes with holes drilled in the fuselage of its 737 MAX jet. It's the latest in a string of manufacturing lapses at Boeing, including the panel blowout on an Alaska Airlines 737 MAX last month. The FAA has stepped up scrutiny of Boeing's manufacturing and supplier systems. FAA Administrator Michael Whitaker is scheduled to testify on Capitol Hill on the Boeing blowout tomorrow. Lisa, how many times have we said this? The more information you get about what's going on at Boeing, the more disturbing it becomes.
We don't want to hear about bolts. We don't want to hear about drills, holes being drilled. This is not what you want to hear. You want to hear, you get on the plane, you go. You don't want to hear anything about it. Boeing shares are down 20% so far this year, just to give you a sense. It's brutal, and it hasn't been good in the previous couple of years either.
And the stock in the pre-market not doing great either. Let's finish on this story. Futures pricing in 5 Fed rate cuts this year on the heels of the stronger than expected January payrolls report and Powell's cautious outlook. Subhadra Rajappa of SocGen weighing in, writing this. Our call is still a first rate cut at the May meeting and 150 basis points of cuts for the year. Given the strength in the economy coming into this year, we question the magnitude of cuts priced in. Subhadra, I'm pleased to say, joins us now. Subhadra, good morning.
Good morning.
It's good to see you. What a blowout report on Friday.
Yes.
What did that change for you, if anything at all?
Not a whole lot. I mean, I think that the employment figures tend to be lagging. What I'm looking at is Thursday's initial jobless claims rising ever so slightly, continuing claims going up. So to me, the forward indicators are a lot more important than what happened last year. I mean, of course, everybody knows that we've created 250,000 jobs on average every month last year. The question is about what comes in the data that's coming forth.
Would you put more weight on claims than on that report on Friday? And how controversial is that, speaking to clients at the moment?
I can't say that I weigh one more than the other. You have to kind of look at the data in aggregate. But to me, the claims data tends to be a leading indicator. So the focus will shift from the headline employment figures to the claims figures going forward.
How much are you going to be listening to Fed speak, and how much did you really pay attention to Powell last night?
I did. I mean, he didn't say anything new that we didn't already know after the press conference. It looks like he's leaning towards a June rate cut as opposed to a May rate cut, which is our call. But the economy's been extraordinarily strong, so they have the luxury of waiting before they start cutting rates. So there's really no rush for the Fed to come in and cut rates soon. But, you know, the risks, especially late in the cycle, are always biased towards cutting sooner rather than later. I mean, we had these headlines last week on the NYCB bank. So the focus is going to be on what is the next shoe to drop. And under the circumstances, I feel like the Fed is locked and loaded to cut rates if needed.
I feel like Ed Yardeni and Subhadra Rajappa are looking at two completely different economies. We've got Ed Yardeni saying that you're kind of at early cycle. We heard the same thing from Lori Calvasina, and you were saying we're kind of late cycle. Which is it?
You know, there are no clear signs as it stands that a recession is imminent. The data, generally speaking, has been extraordinarily positive. We are not seeing the kinds of circumstances that you would generally see for a rate cut. But, you know, things could change very soon. And that's really what we're looking at, is we could potentially see the Fed coming in and cutting rates even to orchestrate a soft landing. So, you know, it's not an environment where the Fed won't cut rates. It's a question of magnitude. And perhaps the market is overpricing the number of cuts for this year. So maybe they don't deliver 150 basis points of cuts. A 90s-style environment where they cut a few times, but not really a full-fledged rate cut cycle, is an underpriced risk.
There is also a question about the longer-term inflation outlook and whether this is a Federal Reserve more accepting of higher inflation for longer. How much are you starting to bake that into your expectations for yields of the longer term?
So the yields for the longer term, you know, at least in my view, are not so much at this point led by our views on inflation, but led mostly by the supply-demand outlook. And that's really where I think it gets a little bit interesting, because once we get past the middle of the year, I mean, the deficits picture is still here to stay. If the Fed does cut rates, I think that there's a potential for the yield curve to steepen and for 10-year yields to actually start experiencing a little bit of pressure and term premium starting to build up. Because, you know, as you guys were talking about, I mean, there's more issuance to come down the pike. There's not really much willingness on either party to reduce the amount of work on deficits or deficit reduction or spending cuts. So in that sort of circumstance, I see that the supply is going to continue to weigh on the long end of the Treasury yield curve.
Sally, I'm curious from your perspective how you're factoring that into some of your calls longer term. If inflation or even if term premia are higher, how that changes the balance and what diversification means.
Yeah. You know, we believe in diversification regardless of, you know, if there's inflation, we tend to be more in the equities. The equities can tend to do well when you've got inflation, which, you know, when we're looking out to investing for our clients 10 years, 20 years, 30 years, you know, getting them to the, you know, where they need to be on retirement, where, you know, we feel good about it.
So at this point, are you sort of mapping out longer term that it's going to be inflation or that it's going to be, as Subhadra was saying, risk premia as a result of what we see with the deficit?
We tend to go more to the risk premia side as opposed to the inflation side. And in fact, you know, inflation is not down to the 2% yet, but it's on its way, you know, and I think there can be a call that, you know, we can look back at this from next year and say, yeah, inflation actually was a little transitory, wasn't it, as it turned out. And I think, I don't know how you feel, I feel like the Fed has been doing a pretty terrific job navigating through this.
Yeah, I mean, this has been an extraordinary year or two, and I think that the Fed's done an exceptional job. And now it's time to pull back on accommodation, and I think that they're ready to do that as well.
So, Badger, what do you make of what happened with the banks last week? Should that be on our radar, or can we discount that? Can we ignore that based on how it was dealt with last year?
Yeah, I think we should not pay nearly as much attention, but I'm always looking for the next shoe to drop this late in the cycle, right? So it is one of the many metrics that we look at. I mean, commercial real estate has been coming under a lot of pressure, and the sooner the Fed moves rates lower, I think it's better for bank portfolios, broadly speaking, because of unrealized losses.
Yeah. So what I would say, I think the Fed has done a terrific job with interest rates. Where they did drop the ball for a period of time was around bank regulation, bank supervision with SVB. And it now feels like it's in the background, and whew, that was scary for a second. But they've admitted dropping the ball, and I think now we're all over. I think we can take some comfort that they should be and are all over the banks with regards to this. But, you know, things you don't love are the words bank and bear market in the same sentence. And every day we're going to be fine when rates are higher. It's not when rates are high, it's the getting from, you know, low rates to high rates that really have killed them.
Well said. Sally, it's good to see you. Thanks for being with us. Sally Krawcheck there of Alavest, together with the brilliant Subhadra Japa of SocGen.
I didn't get brilliant?
You can give a brilliant as well. On a brilliant.
By the way, sort of smart.
Let's
Everyone
rewind.
who does this and he gives one guest a brilliant.
Mohammed Al-Arian got jealous about that, didn't he? Mohammed
So you're in good
sore
company.
about that too. We'll do it again. The brilliant Sally Krawcheck, the brilliant Subhadra Japa. Better? Good. All right, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Shares of Estee Lauder surging this morning after the company announced plans to lay off as much as 5% of its workforce. Sales and profits at the company have declined in the past year due to plummeting sales at duty-free shops and airports and softening demand out of Asia. The company also cut its adjusted earnings per share outlook for the year ahead. Shares of Caterpillar on the rise after the company reported higher sales in its energy and transportation business last quarter that helped the company post profit that beat estimates. The machinery maker is seen as an economic bellwether. Its better than expected earnings providing further evidence of the resilient U.S. economy. Chipotle is getting ready for its so-called burrito season. The company announced it will hire 19,000 workers over the next month in preparation for an annual surge of burrito consumption. March through May is Chipotle's busiest time of the year, with a nearly 20% increase in burrito sales. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Up next on the program, regional banks in the spotlight.
I certainly think there are other smaller regional banks that are also probably under-reserved. So this is probably not the first piece of bad news that we could get, you know, on the regional banking sector.
That's coming up next, live from New York City. You're watching Bloomberg TV.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From New York City, equities negative by 0.13% on the S&P 500. Yields higher by 8 basis points, inching towards, and there it is, 4.1% on a US 10-year. Under surveillance this morning, regional banks back in the spotlight.
I certainly think there are other smaller regional banks that are also probably under-reserved. So this is probably not the first piece of bad news that we could get, on the regional banking sector. So I think you have to be cognizant of those kind of risks. We know that there's a recession happening within the CRE market, within the office market, but it's just the question of the kind of broader spillovers into the economy, which we think will be manageable.
Here's the latest this morning. Concerns about another regional bank crisis looming after New York Community Bank Corp reported a loss tied to deteriorating credit quality. Alexander Yoakum, senior equity research analyst at CFRA, writing this. This collapse was relatively unique to NYCB. However, we still expect the regional bank group to feel the fallout of NYCB's tough quarter, and we expect banks to respond with continued reserve builds. Alexander, I'm pleased to say, joins us for more. Alex, good morning to you. Let's start with the uniqueness of this institution first and build from there. How unique and, dare I say, idiosyncratic are the issues that this particular bank faced in the last quarter?
Yeah, thank you. Thank you for having me on. I just want to set the stage first. If you think about last year, it was definitely the deposit story, right? Yeah. It was all about which banks have uninsured deposits, right? Are they leaving the bank? Can banks sort of maintain deposit funding costs, that type of deal? We think this year, 2024, will be the year of credit quality. Right? And with NYCB, they have 60% of their loans in commercial real estate / multifamily versus a typical regional bank about 30%. And then the top 10, it's much less than that, right? So definitely unique in terms of their exposure to commercial real estate. They were also far less reserved, right? So the amount of money they had set aside for bad loans was far less than the typical bank, right? We're talking like 50% less. Now, I'm sure they would have argued that that's because, their credit quality was better. But then the fourth quarter, when we saw the credit quality get a lot worse, all of a sudden, you start asking questions, right? So that was bad as well. And then in terms of capital levels, they were actually the least capital. They had the lowest capital levels in our entire portfolio. So under-reserved, undercapitalized, and their credit quality just got worse with extra commercial real estate exposures.
When we speak to individual banks, and we spoke to a couple of CEOs last week, the response that we got was basically, our book is okay, don't know about everybody else. That seems to be the response we get all the time to commercial real estate. Is there something specific about the regions some of these regional banks are in? Are some regions worse than others?
Yes, but it's worth pointing out that they really only had 2 loans go bad, right? So if you have 1 or 2 loans get bad, all of a sudden you can start freaking out when it's like, well, maybe that was just a one-off, maybe it wasn't. So, what we think is even banks that have strong credit quality, they'll probably still be pressured to raise reserves just in case something happens, right? So NYCB would have argued, we had basically no charge-offs for 4 straight years, right? That's throughout the pandemic, last year, this year, everything was fine, and then all of a sudden, 1 quarter is bad, right? So even banks that are in good position, even banks that maybe are in better markets than potentially New York or San Francisco, even those banks we think might face some pressure to raise those reserves.
So let's talk about what actually is happening under the hood. Jay Powell yesterday in the CBS 60 Minutes interview came out and said there are some smaller and regional banks that have concentrated exposures in these areas, namely commercial real estate, that are challenged. We're working with them, he said. This is something we've been aware of, and we're trying to figure out how to maneuver through what he said is expected losses. How do you think that they're working with these banks right now?
Well, I mean, we did see with NYCB, I mean, they were increasing their reserves, slowly, but all of a sudden they increased it substantially, right? And I mean, even multifamily, right? They basically doubled their reserves in a quarter. I mean, you can say, the credit quality is fine, but if you're doubling the reserves, you're either pressured to do that or, you feel like you could have some potential losses down the road.
Can you give us a sense of what number of banks that really could be pressured that you foresee, right? Is this 1 more? Is this 2 more? Is this really like going to be 50, where suddenly we're talking about a whole swath getting kind of excised or merged?
Yeah, so we analyzed the top 30 banks, and basically what you see is any bank above $100 billion in assets outside of NYCB is generally better capitalized, better reserved, and generally has less commercial real estate exposure. So we would expect the pressure to be below that $100 billion in assets, and there might be a little bit of additional pressure with names like Zion, Comerica, First Horizon, as they're the banks that are closest to $100 billion. So now there's talks, if they're going to pass that $100 billion, how would they fare, right? So Zion is a little bit low on reserves, right? Comerica has had securities issues. First Horizon had a deal fall through last year. They were going to get acquired, right? So all 3 of these banks have had some issues in the last year and, potentially could face increased scrutiny, and they have high commercial real estate exposure.
So it seems like a great recipe. Here's a question. There's an issue of whether this is systemic risk and something that's going to be potentially torpedoing the global economy or the local economy. And then there's just the issue of valuation. Do you think that valuations have already accounted for what the weakness is that you foresee?
Well, they will unless you get those unexpected charge-offs, right? So generally speaking, the valuations, are depressed, and, banks that don't see increased net charge-offs will probably be good buys, right? We think the regional banks are not all the same. There's a big difference between the strong ones and the weak ones, right? So, the banks that do see unexpected losses, there's going to be issues there. But some of the banks that have high commercial real estate exposure, they've reserved. They have high capital levels, right? It's not all of them, right? So there's definitely a dichotomy there, and there's differences.
Elisa touched on this a little bit. I'll ask this question on behalf of the economists listening to the program today. Does this hinder the ability of regional banks to finance the economy? Do you see them pulling back on lending, tightening lending standards? Is that happening?
Yeah, unfortunately, it is. Banks that are struggling are talking about cutting loan exposure, right? So they're not even going to grow with inflation. They're actually going to have loan balances that fall, right? That includes NYCB. Another name like KeyCorp that struggled. We wouldn't be surprised if their loans went negative last year in terms of growth rates. So it does hinder them, and especially if you're asked to increase capital, right? It's a difficult time to be kind of increasing those loans.
Is this where these issues can become somewhat self-fulfilling? Because that starts to hurt the economy starts to roll over, that starts to hurt valuations, and then the loans don't get repaid in quite the same way. People can't acquire new property, you don't get that demand, then you start to get prices hit again. Does this become self-fulfilling? Are we starting that process?
Yeah, it can be. I mean, definitely with banks, there's more self-fulfilling prophecy, right? With a different type of company, if the price falls, that's usually like a good buying opportunity, right? As long as the fundamentals hold up. But with banks, it's all about the trust, and, people are just less likely to want to deal with these banks. I mean, they've talked about, potentially, being, more cautious. And yeah, I would agree.
I made that sound really gloomy, and I didn't mean to. Alexander, thank you. Alexander Yoakum, CFO.
I was thinking
that. Starting to sound like Bramo. Sorry. Lisa, go.
I was kind of getting excited. You're talking about this sort of doom loop. After all these people talking about the roaring 20s.
This was the worry of last spring, though, right?
I know, which is sort of shocking that people aren't worried about it, because now they think either it's baked in or accounted for, and some of the other credit creation will overcome it. I think that's an open question. I mean, really, if you think about this financing the bulk of small businesses, maybe that explains why the Russell 2000 is lagging behind so much.
And I go back what Barry Sternlicht said, 1.2 trillion of these assets are tied up somewhere that they're going to come home to roost.
And everyone says it's not our problem, it's theirs. You hear that on repeat, don't you?
Yeah, and so the question is, who is it? And I keep going back. Jay Powell really addressed this, and he really acknowledged the fact there are going to be losses. This is yesterday, and saying they're working with them. How are they working with them? Are they overseeing them? Are you just saying, you know, how do you just adjust some of the regulation to hide some of the problems long enough to work through them?
Well, was last year a failure of regulation or oversight? I think a lot of people would say it was oversight and not regulation, right?
That's what a lot of people will say.
Which is why in Washington, D.C., you see a lot of people pushing back on these regulations, and the bank CEOs are coming in and saying, we expect them to be watered down.
It's kind of an odd situation, isn't it? You're going to get the small banks, the regional banks pulling back on lending, tightening lending standards at a time we're talking about an economy that's not going into recession and the Fed has to stay on hold for longer. This is why some people say, you know, Andrew Hollenhorst of Citi asking a question after the payrolls report came out on Friday, soft landing, what soft landing? The more this stuff becomes delayed, ultimately, the harder it becomes to land that plane softly. This economy with no recession in the next year.
If you don't have recession, can you get ongoing disinflation?
Right.
And that is still the underlying question. And I will just say this, even with regional banks having those issues, shadow bankers can come to the equation, right? I mean, thinking about commercial, some of the auto loans and others that have migrated. I mean, it's not like it's going to be a complete removal of credit altogether.
Plenty of questions for the next hour on Bloomberg TV. Coming up, Bank of America, Savita Subramaniam, Henrietta Trays of Veda Partners, Manulife's Francis Donald, and Nadia Martin-Wigan of Svelland Capital. All of that and a whole lot more in your equity market right now. Pulling back just a touch. We're down 0.1% on the S&P 500. Yields a whole lot higher by 8 basis points on the 10-year, 4.1%. From New York City this morning, good morning.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody he brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
This is Bloomberg.
This is a very strong report and a strong labor market. The Fed doesn't have to normalize policy as quick.
There's no data there that says we are headed toward a cliff or we're going to have a sudden shift in growth.
Some signs of softening, but so far very gradual signs of softening.
This means markets off the table. It also means that you are more likely to get the 3 cuts that the Fed has signaled.
Whether it's March or May or June, I think it's in that time frame that we expect the first cut.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrow. Your equity market on the S&P negative by 0.1%, 90 minutes away from the opening bell. The quiet period is over for the Federal Reserve. The Fed speak has already started this morning. Neil Kashkari of the Minneapolis Fed in an online essay, Bramo policy is not too tight, and based on payrolls on Friday, policy is not too tight.
Well, and basically saying that the neutral rate may have increased, and this is really one of the key questions of whether maybe we are running at a new normal that is hotter, and one where we have enough momentum to keep growing at this pace, even with 5% rates. It is possible that policy stance represents neutral has increased, given the timing of the Fed going forward. It still is going to be a matter of assessing the data to get the right mix of when to cut rates.
Are we sufficiently restrictive? At the moment, the Federal Reserve seems to have this risk-friendly stance, which is if the economy is doing well, we don't have to hike more. But if it starts to underperform, we can cut. I do wonder after Friday's payrolls report, though, if you get a few more like that, just how far do we push back that first cut to?
I would guess pretty far, because if you take Jay Powell at his word, he is concerned about inflation maybe running hotter than they previously realized, and they've gotten this wrong before. So this really is a sort of question mark. That said, a lot of people looking at the forward-looking kind of claims and things of that nature would show a different picture.
And then you start to get closer and closer to the election in November. Stephen Stanley, Santander, last week on this program, talking up 50 basis points of cuts from the Fed. Not at the next meeting, not the one after that, for the whole year and starting after November. And Anne-Marie, he talked about the election being a key date on this calendar. And I just wonder, if you do get a change from President Biden to President Trump, and President Trump goes into the White House talking about 60% plus tariffs on China, whether you have to really start to alter, recalibrate your outlook for inflation for 25 and beyond.
You absolutely have to recalibrate not just the 60% potential blanket tariffs on China goods, but also this tariff wall the Trump administration 2.0 potentially is talking about of all imported goods. And what does that mean for consumer prices? Well, they're going to skyrocket.
You can't separate this conversation from the price action in Chinese markets right now. I really don't think you can. You're seeing wild swings in Chinese equities, and no doubt that is a big, big issue to anyone investing there.
And let's be clear, it's not because people are gaming out exactly what 60% tariffs would do. It's because uncertainty and ratcheting up in the tensions, which will only increase going into the election. How do you have any conviction in a business plan in China? How do you have any kind of investment plan in Chinese equities? And this, we hear again and again from guest after guest. Is it even what ends up getting put into place, or is it just the suggestion of volatility in policy?
Right. Is this just leverage going into potentially becoming a president and wadding that leverage at the negotiating table? But Goldman Sachs, to your point, Jonathan, is saying that what Trump is talking about is starting to unnerve onshore clients. And they put out a note saying they're very worried about what this might mean.
The number one question right now, so Chinese equities, multi-year lows, US equities, all-time highs. Equity futures on the S&P just pulling back a little bit from those levels. We're down 0.1% on the S&P. Yields are higher by 9 basis points now. Lisa, 4.1136 on a 10-year.
Climbing as people assess the data and the fact that Jay Powell was taking March, not off the table, but kind of off the table. even before getting the data on Friday. That's really telling in terms of where the bias is.
2-year, 444.51, up 8 basis points at a very front end of the curve. Coming up this hour, here's the lineup for you. Savita Subramaniam of Bank of America weighing in on the Magnificent Seven euphoria. Henrietta Trey's of Vader Partners on the Biden-Trump rematch. And Manulife's Francis Donald on Chair Powell's rate cut cold feet. We begin with our top story. Stocks moving lower after a tech-fueled rally. Savita Subramaniam, head of US equity strategy at B of A Global Research, saying this: the idiosyncratic versus macro risk is high, and the Magnificent Seven is not a monolith. In fact, this reductive moniker obscures the companies are behaving very differently from one another. Euphoria is evident for the Magnificent Seven, but nothing else. Savita, I'm pleased to say, joins us around the table. Savita, good morning.
Good morning.
Let's get to that monolith, and thanks for being with us. How different is the performance now in those 7 stocks?
So it's interesting because I feel like even though we all think of the market as being just this one direction, 7 companies leading the charge, the stocks themselves are acting very differently. And if you just measure idiosyncratic risk as like kind of non-market specific risk, we've actually seen a surprising increase in stock-specific risk. So what this means in English is that you can actually make more money picking stocks than just buying the index outright. And that's been our call for a while. I mean, I think what's been a little bit unnerving about this year and the last few months is that we haven't necessarily seen a broadening pattern emerge in the market. We're still seeing leadership pretty decisively in this cohort. But look at what happened after earnings for some of these companies. I mean, these stocks are priced for perfection. Everybody owns them. They're pretty expensive, maybe not as expensive as prior tech bubble levels, but they're relatively healthy in terms of valuations. And I think that what happens from here is a broadening to other areas of the market that aren't necessarily as risky as we think.
We say they're priced to perfection, then they rally another 20% in a single day. It's scratching my head. I just wonder what the takeaway from Friday's price action is.
So you know what I think was interesting is that one of the drivers for that big bump was initiating a dividend, a big growth company initiating a dividend. And I think that's a really important signal because, our call is that we're at a point where the next leg higher in equities is likely to be retirees maybe moving out of cash back into riskier sources of yield. Of course, this was predicated on the idea that the Fed was going to start cutting interest rates, which obviously is, a bigger question today when that happens, kind of how much, how soon. But I do think that the idea of this wall of cash sitting there in money market and short duration bonds that's earning 5%, if that starts to come down, or if you start to see equity yields come up, like we are in certain parts of the market, I think that could be the value proposition for equities again. It's kind of like TINA 2.0.
TINA 2.0 happens when rates start getting cut.
Yeah.
And the economy keeps chugging along.
Exactly.
How much does it shift your thesis if the rate cuts don't happen as soon as deeply as the market's currently expecting?
Yeah, so I think this is a slow evolution, but I guess I don't think you have to wait for the Fed to actually cut interest rates to think about equity yield, because think about what's happening right now. The reason that the Fed might not cut is because of an inflation surprise. How do you want to protect against inflation? And I've said this before a couple of years ago. I think equity income is the best way to protect a retiree's assets from inflation as well as offering income. So that, I think, it becomes the name of the game again. And if you think about, a couple of years ago when we had rampant inflation, the Fed was hiking rates, equity income actually did really well. The high dividend yielding stocks were one of the best places to be in 2023's bear market.
So why is it not working yet?
Or 2022's bear market.
It's fine. No, but I'm just wondering why
isn't it working?
Because I'm thinking, I'm looking at the Magnificent Seven or Magnificent Eight, whatever you want to call it. You're right. It is diversification now away from the Magnificent Seven to the Magnificent Two in Meta and NVIDIA, basically, this year. How much do you start to question the thesis if it's not being borne out now?
Well, I think that the reaction to, typically if you think about a big growth company initiating a dividend, a tech company initiating a dividend, that would be anathema. But I think investors want that. They want to see companies have capital discipline. They want to see companies returning cash. They want to see these big growth behemoths actually give us back a little bit of money.
Financials. You were overweight financials. You still overweight the
I'm
banks.
still overweight the banks, yes.
What is it you like about that sector?
I think that there's still this underappreciated aspect with large cap banks that has yet to be recognized by the market. And that's the idea that when you look at the underlying earnings trends of large regulated companies, they're actually relatively healthy. These are well-capitalized companies. Dividend preservation is not necessarily at risk like it is for some of the regionals. I think we're at a point where the regulatory environment is likely to flatline from here, not get any worse for at least the big guys, and I think that that's a positive. I mean, if you think about inflation-protected yield, again, I think of financials as a good source of it.
The emphasis was on the big guys.
Yeah,
I think we all noticed that.
Small.
What's going on with the smaller guys?
So I think it's too soon, especially if we're not in an all clear, you know, Fed's gonna cut rates a bunch of times this year. I think that you wanna stick with larger, well-capitalized financial companies, and that's been our call. I personally worry a little bit about small caps, and you know, we're bullish on small caps with a very big caveat that there are still a lot of smaller companies that are like banks, like real estate. There's a lot more risk around, you know, just the fact that the Fed moved from 0 to 5. A lot of that attrition and that sort of pain is happening in the smaller benchmark rather than the larger benchmark.
Energy. We heard from Lori Calvasino as a hedge against inflation. Is it still a hedge against inflation, or does it just hold a whole host of other risks?
I think energy is an interesting sector, and from the risk perspective, my sense is that a lot of those risks are priced in at this point. If you think about it, these companies are no longer just extracting oil from the ground, you know, at the least provocation of a price hike in oil prices. They've got discipline around production, which means that supply is going to be constrained, which means earnings are going to be less volatile. I think this is a sector that plays a role in getting to net zero if we ever do. And it also is a source of really healthy yield. And the companies have told us they are laser focused on preserving cash return rather than, you know, production targets. I think that's the big sea change in the energy sector, is that these companies now have discipline. It's very different from, you know, prior to 2017.
It's been a massive change. 72 on WTI, by the way. Brent crude at 77.21. Savita is going to be sticking with us, I'm pleased to say. Not to talk about US politics, but a bit of US policy in the mix. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. China is trying to fight a deepening stock market plunge by tightening trading restrictions on domestic institutional investors and some offshore units, according to Bloomberg sources. The country is trying to stabilize markets after shares sank to a 5-year low in trading on Friday, with the CSI 300 index down 4% since the start of last week. And Boeing lower in pre-market trading after the aircraft maker revealed it found more issues with holes drilled in the fuselage of its 737 MAX jets. The latest problem originated with a supplier. It will require repairs on about 50 undelivered jets and may delay plane deliveries in the near term. The defect follows a string of manufacturing issues at Boeing, prompting the FAA to step up scrutiny of the company. McDonald's fourth quarter sales missed investor estimates as growth slowed, hurt in part by the war in the Middle East. Same-store sales rose 3.4% in the period, marking the slowest rate since 2020. McDonald's became a target for boycotts after the war between Israel and Hamas broke out over its perceived stance on the conflict, as well as its status as one of the most recognized American brands. That's your Bloomberg Brief. John?
Yahara, thank you. Market cap as of Friday, $215 billion US. So we added almost the McDonald's to Meta Friday, which is just, the more I think about it, the more nuts it is.
It's absolutely nuts that a $50 billion set aside for additional dividend added $200 billion in one day to the market capitalization of the company.
And that dividend too, as Savita pointed out, important stuff. Equity futures more broadly down about 0.1% on the S&P this morning. Up next, President Biden hitting the campaign trail.
This is not just a campaign. This is more of a mission. We cannot lose this campaign for the good of the country. And I mean that from the bottom of my heart.
That's coming up next on the program, live from New York. This is Bloomberg.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
A little more than 1 hour away from the opening bell. Monday morning, good morning to you. Equity futures on the S&P 500 negative by 0.15%. Yields up by 9 basis points. Do I seem over it already?
Yeah.
Is that what you were laughing?
Yes, because you just sighed it out.
Monday?
It's Monday again. Here we are.
Here we go again.
Gonna do this again? It's gonna
Under
be fun.
surveillance this morning. President Biden hitting the campaign trail.
The guy we're running against, he's not for anything. He's against everything. It's even worse than in terms of his behavior than the last time in 2020. This is not just a campaign. This is more of a mission. We cannot lose this campaign for the good of the country. And I mean that from the bottom of my heart.
Biden feels the same way. Here we go again. Here's the latest. A recent NBC poll showing Biden trading Donald Trump by over 20 points on major policy issues, including the economy. Henrietta Trey's of Vader Partners saying the president can make a comeback, writing this. Biden's low standing will rise as Democrats and independent-leaning Democrats acknowledge he will be the nominee. Voter sentiment on the state of the economy will begin to improve, which may provide a double benefit for Biden as the incumbent president. Henrietta, I'm pleased to say, joins us now for more. Henrietta, let's get into your base case first. And as always, fantastic to catch up with you. You've got Biden winning the White House, and I believe you've got the GOP winning the Senate. So the first thing we were going to last week is the swing state polling we did at Bloomberg here with Morning Consult. And the president's behind Trump in all 7 key swing states. Can you go through with a little bit more detail what turns that around as we go deeper into 24?
Yeah, absolutely. Thank you so much for having me. The first thing that I point out to investors, and as we talked about a couple of weeks back, is you want to skate to where the puck is going with polling data. And your poll out of the 7 swing states was phenomenally informative in that you're starting to see voters come off the bench and start to pick a candidate. And what we have noticed between Republicans and Democrats is that there are far more undecided independents and Democrats than there are Republicans. In some of the polls, there's 8% of the Republican Party that's undecided versus 19, and as far back as December, 30% of Democrats who were still unclear about which candidate they were going to pick. Now, in America, we don't change our opinions that often. We just don't come home to our party nominee, particularly this year, until we have to. And so that's why we say, you know, the polling data has an R-squared of 0 right now, because it's not predictive before Super Tuesday. On Super Tuesday, it starts to get about a third more predictive. And then that increases by a third again in June, July, and then that final third in October. And so what you saw from the Democratic Party over the weekend was a substantial ad buy that I think lends credence to my thesis here, that there's going to be a tremendous amount of campaigning and activity to get those final sway voters in the August, September, October period, which is when they bought, I want to say, something like $200 million worth of ads for that period in the swing states. So your polling and many others suggest that there is a tremendous amount of not apprehension so much as just unwillingness for Democrats to say, okay, Biden is our candidate. Now, we do have the conflicting data set of South Carolina yesterday, which went 96% for Biden. That's not confusing. There's no lack of clarity there. That's a resounding victory, as his competitors pointed out themselves. So I think what the polling is showing us right now is that there is a segment of the population that's larger for Democrats and independents, that's undecided, and most of the room to gain stands with Biden, as a lot of the Republican voters are already clear that they're going to be voting for Donald Trump.
Henrietta, a lot of the polling also shows that this is just a rematch Americans do not want to see. What do you make of some of these third-party candidates? I look at Gallup polling, and RFK has a 50% favorability. Where does he draw from? Trump voters or Biden voters?
Well, I think some of that you'll see from the age demographics and the white versus black versus other minorities makeup. Those voters, I think, are also trying to send a message, which is very much akin to what we saw, I think, almost with Bernie Sanders. Not that the two of them are the same kind of candidate, but there's a holdout vote that's saying, look, I want to push the party in a different direction, whether that's Republicans trying to muddle the field for Biden, or Democrats saying, hey, look, I want a more progressive candidate. Joe Biden has tacked more towards the middle recently, and there was profound profound resentment with things like the Bipartisan Infrastructure Act. If you'll remember that from 2 years back, when you had sort of a standoff between progressives and the establishment of the Democratic Party. So I see a tremendous amount of corollary between the 2020 election and this one. And in fact, if you layer on top of that any amalgamation of data from the last 6 months of polling, you'll see that that same skew of voters who is hoping for someone else and isn't willing yet to come home to Biden are saying that they go for RFK, Marianne Williamson, Dean Phillips, those other candidates. And eventually what happens is they realize that there is one party nominee. We are, for better or worse, a two-party system in America. There is no scenario where a third-party late entrant or unicorn candidate comes into this race. And I think a lot of the polling is still suggesting that that's possible, which is fine. I mean, that's within Americans' rights to say they want to wait. But usually that starts to diminish on Super Tuesday, which is March 5th.
Our polling shows that as the economy is getting better, immigration is becoming more of an important issue. Of course, you know that the Senate last night finally released the text of the supplemental. Do you think that there will be a chance that this deal will actually be reached? Terry Haynes is putting it at 60% probability. I'd love to know your percentage.
No, with all due respect to Terry Haynes, I think 60% is inordinately high. I do think that you could get piecemeal buckets of spending on Ukraine and Israel as we have the continuing resolutions and the risks of government shutdowns for the next couple of months. But there is a tremendous amount of disconnect on the street right now about this bill and also the tax bill that I would just reference briefly. That's a $78 billion tax package that I think has a lot of political similarities to the border and Ukraine aid package. It's something that is absolutely a win for every sitting member of Congress. All of them on the House side are up, and 8 very at-risk Democrats are up in the Senate. And the reality is I don't think you're going to see either of those bills, definitely not the tax bill. It's just a huge political boon to the incumbent for both of these projects. And that's why former President Donald Trump has come out so forcefully against it. And the Republican candidates in the House, the Republican members, are lambasting it really before they even saw text. Their misinformation out there, I don't see this bill passing the House.
We spend so much time talking about these things that just never get done.
So exciting.
Lisa, every single time. Henrietta, thank you. Just awesome as always. Henrietta Trey's there, Aveda Partners.
But exactly to that point, how do you strip out the noise from the signal, especially from a market's perspective? And Savita, I do want to get your thought on that. What do you pay attention to that's actually market moving versus just what we always get, which is the reason why everyone tunes it out?
Right, the narrative. So, I mean, I think what's interesting is if you look at the data, there is one unequivocal statement I can make with total confidence. Nobody is betting on a cyclical recovery when it comes to professional investors. And when you look at the average hedge fund, mutual fund, even the average individual investor, what do we own? We don't own energy or financials or high beta. The beta exposure of the average mutual fund today is almost the lowest level we've seen since the financial crisis. I mean, I think that's what's interesting is that despite the fact that the economy seems to be running maybe too hot, there is no bid on that theory.
I remember all of our conversations, and I remember the one coming out of 22 into 23, and you said the biggest risk was upside risk to equities.
Yeah.
Let's put price targets to one side. Let's talk about risks right now. What is the biggest risk then for 24?
So I think the biggest risk to the S&P 500 in the near term is upside. I think that even our target 5,000 is probably too low in the near term, but I do think that the reason we're not as optimistic on stocks today is that we have seen this percolating positive sentiment, especially around the Magnificent Seven, which is the area of, abject, euphoria. So I think that area of the market is at risk, but I do see this lack of real conviction in stocks outperforming bonds. I still think that stocks, then cash, then bonds. That's the lineup you want to have.
That's the hierarchy. Interesting. Savita, good to see you, as always.
Great to see you.
Great to see you here in the studio. Savita Subramaniam there of Bank of America. This from Goldman just moments ago. We published our forecast of the first rate cut back to May, pushed it back after Chair Powell said a March cut is not the base case. They did have March. This is what they've got now, Lisa. We see a risk that it could come later after these 60 minutes interview.
The fact, again, that Jay Powell was not talking about March and said it wasn't likely before seeing the jobs report, and that, oh yeah, it wasn't just an accidental slip in response to a reporter. This was a deliberate, thought-through point of view. That's a game changer.
It took on new meaning after payrolls on Friday. Coming up, that discussion, Francis Donald of Manulife Investment Management on why March and May are too early for the Fed to cut rates. That conversation up next, live from New York City, about an hour and 4 minutes away from the opening bell. Equity futures on the S&P 500, just slightly negative.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
60 minutes away from the opening bell. Equities pulling back just a little bit on the S&P 500, down 0.25% after 4 weeks of gains on the S&P. Amazing to think about the weekly gain that we did get, even with the biggest one-day drop going back to September on Wednesday. Lisa, equities doing okay?
And really, it comes from the earnings. We have to just keep emphasizing that the earnings of Meta, the earnings of Amazon really highlighted how the big tech names have really driven this through the cash that they generate, not just through hype.
Quite a sell-off in the Treasury market if you switch on the board and turn to Treasuries, 2-year, 10-year, 30-year. 10-year yield up by almost 10 basis points now, 4.11 on a 10-year. On a 2-year up 7, 4.43. I mentioned the Goldman Sachs note before the commercial break. Let's bring it up again, Lisa, and talk about it. They had a March rate cut call. After Chairman Powell, they pushed that out to May. And after the 60 minutes interview, they're basically saying the risk now, and not the base case, but the risk is now it gets pushed out even further. You breathed some life into this conversation a little bit earlier. The importance of that. For me, it just sounded like what he said on Wednesday. Why was it so important to you and to others too?
There was speculation that he was just throwing out March there in sort of an off-the-cuff way in response to a reporter saying, you know, it seems like it's not our base case for it to be March. It was almost like just bubbled out. It wasn't a statement. It felt very much that way. The fact that he laid out the case and why he is not interested in cutting rates in March in this 60 Minutes interview that was taped before we got the Friday data, to me, was a game changer because it highlighted that their bias is toward waiting to making sure they have the accurate data.
Yeah, I thought the timing was so interesting. He doubled down on not cutting in March before the U.S. jobs data. What would have he had said if this was taped Saturday morning?
That's why the Fed speak a little bit later this morning. It's going to be interesting. I believe that Mike McKee is catching up with Mr. Goolsbee of Chicago, so look out for that conversation later on this morning. Under surveillance this morning, the Chinese stocks seeing another volatile session as investors mull the latest pledges by policymakers to stabilize the slumping equity market. Shares rebounding in afternoon trading after the securities regulator said it would take steps to prevent risks from share pledges without providing many details. Margin calls and forced liquidations are emerging as the key risks facing investors in China. So they're pledging to do a whole lot more to support stocks, Bramo, without telling us what they'll do to support stocks. Yeah. At the same time, we've got these vows from the former President Donald Trump that if he gets back into power, he's going to slap China around the head with a 60% plus import tariff, which is really out there.
How do they revive confidence at a time where international investors are really reflecting the policy uncertainty? I mean, again, whether or not he gets 60% tariffs put into place, either way, this is going to be a political football. And it's going to be really ramping up in C-suites when you have executives. If you're a CEO, are you going to be like, I am going there. I'm going to expand my manufacturing there when you're not getting confidence from the Communist Party and you're not getting confidence from the U.S. administration that there's going to be any kind of policy certainty? I don't think so.
I think the surprise, if you talked about this, may be in 2018 when this all kicked off. How would a Democratic president handle this differently? I remember everyone banging a table saying this isn't the right thing for a president to do, it's not the right thing to do. Here we are with the same tariffs today. President Biden has not removed them, he's stuck with them. There was some talk at one point, Anne-Marie, that maybe he would take back those tariffs. He hasn't done that at all.
There was talk when inflation was running very hot and you had the administration trying to pull every single lever. Remember, every time Biden came out, he said, we're going to look at every tool in the toolbox. But at the end of the day, at least the way I read it, it felt like Treasury Secretary Janet Yellen lost that argument and National Security Advisor Jake Sullivan won that argument because it became more of a national security concern, maybe even a political concern, and less of a Treasury concern in terms of what this has mean for inflation.
I'm taking us into the realm of speculation here. As you get deeper into election season and President Trump, former President Trump, starts beating the drum on this a little bit harder, where does President Biden go? What does he do? Hold the ground? Or does he have to lean into the same conversation?
I'm not sure you're going to see the Biden camp lean into 60% blanket tariffs on China. The tariffs imposed by the Trump administration prior, according to the Tax Foundation, says this amount to an $80 billion tax increase on $380 billion worth of imports. So take potentially some of that, model it out. What kind of tax increase are we seeing? But to your point, Jonathan, Biden campaign saying all the economists say this is just a tax on American consumers, yet they kept them in place.
That's the latest on China. Let's turn to our next story on the Middle East. Iranian-backed Houthi rebels vowing to respond to US and British-led airstrikes over the weekend. The strikes targeting 13 locations in Yemen were part of an effort to end the militant group's attacks on commercial ships in the Red Sea. It was the biggest barrage since the original Allied attacks on January 11th. And based on what we've heard from Jake Sullivan, the National Security Advisor, Anne-Marie, there could be more to come.
Yep, and I think we need to also remember there's almost two different tracks here. The United States wants to respond for those 3 American service members that were killed in Jordan, and then there's also the Houthis that are causing chaos, frankly, in the Red Sea. I was struck this weekend about how much the administration is really tied to walking this line. It's going to be a sustained response, yet it's not going to be an open-ended military campaign.
Where is Saudi in all of this? So we brought this up a little bit earlier. So back in 2019, Houthi militants took out a big chunk of Saudi production by causing absolute chaos in that region. Saudi Arabia seems to be sitting back as this plays out between Houthi militants and US and UK allied forces trying to do something about it. Where is the kingdom on this situation?
Well, the kingdom has been trying to hold on to this very fractious peace agreement in Yemen. And I think for them, it's much easier to let the United States and the United Kingdom take on this role of going after Houthi militants.
If you're waking up late and wondering where crude is, crude's down on the session, which is just unbelievable. Again, Lisa, we're down 1/3 of 1%, WTI $72, Brent crude $77.26.
Which is the reason why nobody really wants to bet on geopolitics right now, because if that's your sort of knee-jerk response to buy oil, it's been Widowmaker.
Down on WTI and basically unchanged on Brent crude. Let's finish on this story. Lisa and I were talking about it just briefly. Let's talk about it some more. Fed Chair Jay Powell saying the central bank will look for more economic data to confirm that inflation is headed back to 2%. In an interview in 60 Minutes, Powell reiterating his stance that a March rate cut is unlikely, saying, quote, the danger of moving too soon is that the job's not quite done, and that the really good readings we've had for the last 6 months somehow turn out not to be a true indicator of where inflation is heading. He seemed uncomfortable on Wednesday to commit to this idea we were going back towards 2%, for good reason. And then you get Friday's payrolls report with that wage growth in the mix, and I think you just double down on those comments again, don't you?
People were saying that his bias is to cut rates sooner, and that he was trying to jawbone the market into thinking that they have a hawkish kind of tone when they're actually incredibly dovish. There was that sort of suspicion underpinning some of his comments, that he was trying to soothe the market. This, I think, took that away. This basically said, no, he actually meant it. You have to count on that. And then this morning, Kashkari talking about a higher neutral rate and, you know, really leaning into that only edifies this idea.
Neil Kashkari is not willing to cut interest rates anytime soon. Have you noticed that Chairman Powell keeps saying nearly all members think we'll be cutting interest rates this year? There's someone on that committee that he seems to think is not part of that club.
You think it's Neil Kashkari?
No, I'm not saying that. I'm just saying
Let's
he
move
keeps
into the
saying
realm of speculation.
nearly all. That would be one of the candidates, would you imagine?
I think probably.
Based on what we've heard?
Probably,
Mickey Bowman, another one, Governor Bowman?
Yeah, I think also Neil Kashkari likes to be a contrarian, which I kind of appreciate. He likes to be the one that
leans. We don't want the groupthink on the FOMC.
Exactly.
We're on the same page.
He's the person who always leans the other way.
Francis Donald of Manulife Investment Management doesn't think the Fed's going to cut rates in March or May. This is her quote. Pick your poison. Either the data accelerates and we lose the embedded rate cuts in the market, or the data worsen and we have to reevaluate the embedded soft landing narrative in markets. You don't get to have your cake and eat it too. Francis joins us now for more. Francis, we have got a lot to catch up on. Let's get straight to it. Chairman Powell, 60 Minutes, Chairman Powell in the presser, throw in payrolls. What's the base case now?
We've been June. We've been June for a while, and that may surprise some because we do have a recession in our outlook, and we think they're going to have to cut a lot more than what is currently priced. But the data is just not going to turn in a meaningful way before the June meeting. That's, we think, the earliest they can go. So the balance of risks for us is later but faster. And depending on what kind of investor you are, there might be a trade there in the near term. You can get a little bit more concerned in the near term, or you can play the curve. But it's later and probably more and faster. We have some time to go.
Does that mean, Francis, that the soft landing thesis is more likely or less likely?
Well, the soft landing thesis is what's currently embedded in markets. So you have to pick the balance of risks. That is the game as an asset manager. Are you going to say the balance of risks is actually for a better economic environment than what's currently priced, or for worse? And the challenge, Lisa, is that if you stick to the data, and I know we've been saying this for too long, the data is not pointing up. There is some improvement in manufacturing activity, but it is 2 years from the first rate hike to the impact on the economy, and we are just now on that precipice. So when you lose conviction right on the precipice of when you would see the market reaction or the economic reaction, I get a little bit worried about that. And I think this is where some of the Fed's willingness to wait is going to come from. If interest rates do impact your economy, and maybe they don't, maybe the interest rate sensitivity in the U.S. economy is far less, it will be in the next 3 to 6 months. And if the relationship is broken, we got to throw out our textbooks in their entirety. Leading indicators don't work at all anymore. We will know in the next 3 to 6 months. It is much harder to reverse a rate cut than it is to go faster. Remember, they don't even have to cut on a schedule. They could cut one night when I'm really busy and my kids have a fever. They could do it anytime they want. We have to be mindful of the balance of risks for them and for the economy.
Try just to lift your spirits a little bit on that time when you're dealing with a sick kid. I am just wondering, you said we're going to know in the next 3 to 6 months. What indicators do you expect to turn first? What are you watching to see whether your thesis still holds water?
Well, the big challenge last year was that manufacturing data fell into a recession. We've seen one of the worst manufacturing recessions in modern economic history, and we did not see that bleed into services. So one of the big challenges that we're dealing with is actually disaggregating those two sectors, manufacturing and services, and not believing, as we have historically, that one would bleed into the other. So the really key component for the U.S. outlook going into 2024 is do services decline, and that will lead on jobs. And that's why Friday's jobs market number, a really big problem, not just because it was really strong. I hope it was really strong. I hope that's what's happening for the American people. But we know it was heavily distorted by seasonal factors. We know wages were up because hours worked totally were down. We're still going to have to disaggregate that. It was not a clean signal up or down, and that makes visibility really, really difficult in this environment. It is not the time to have high conviction views at all. Not for strategists like myself, not for the Fed.
You open the door just a little bit. I'm going to ram it open and walk straight through it. Let's talk about it. How believable was that unbelievable data on Friday for you and the team?
So we have a rule on our team: one data point does not a trend make, and we're also big believers in having dashboards of indicators. John, you've probably seen these. Bloomberg has a lot of great ones on the terminal as well. The big problem with Friday's number is that it was relatively inconsistent with a lot of other job market data. So for example, hiring is actually down in the JOLT survey. That survey is also distorted. What about the employment cost index, which is a boring index markets don't usually respond to, but we know the Fed cares about deeply? That says wages are actually decelerating in a really healthy manner. So when we put together this mosaic of jobs data, it's not entirely consistent with Friday's report. And yet, 2023, I got burned by talking through all the reasons that a lot of the strong data was distorted. So you have to find some form of balance. I think dismissing a number outright because we know there's seasonality, you don't have to throw the entire thing out. You have to look for the trend within it. Right now, though, the Fed is going to look at that and say, March is out. I don't think they're going to have enough good data or data supportive of cuts until later this year.
Francis, the lack of conviction there is something that's been a theme. And honestly, what you just said is something that was reflected in a lot of notes. How much has your conviction level gone down where you start questioning whether the models are accurate? Lori Calvasino is saying her conviction level is at a 60% sort of rate for everything that she says. What about for you?
Yeah. Yeah, I think that's accurate. And actually, I would say that your base cases are actually, for our team, carrying more like 30 to 40% probability. And that seems strange. How can you have a less than 50% probability for a base case? And it's because we see such a wide range of potential outcomes and really fat tails in that distribution. So for example, we have a higher probability of a financial accident than we've had in past years. It's not a very high probability, but it takes away from the base case. In this particular situation, though, where we feel a little bit more confident is that if the U.S. does enter a so-called technical recession, it will probably come out faster because the Fed has pulled off of those additional rate hikes. And even though we're debating, is it March, May, June, or July? For most institutional investors that we deal with, and even for retail investors, that's semantics. What matters is there won't be any more rate hikes, and the direction of rates will be lower. I think a lot of this, is it this month or this month, is going to be a very, very tactical trade for those with tactical dynamic portfolios. The key message is that rate hikes are done. That we have extraordinary conviction in. So if you start with those big themes, yes, we have high conviction in those. Growth is slowing, inflation has peaked, interest rates are going down. High conviction on those, haven't changed. Some of the technical details around it, low conviction. The data is just not doing what it used to do, Lisa, and we have to admit that.
Francis, you're one of the best. It's great to hear from you. Francis Donald there of Manulife. Thank you very much. What Francis said there might sound a bit controversial, so let's frame it. I don't think it is that controversial. The data's been in conflict now for quite a while. And I get that when you get a blowout report like the one you get on Friday, it sounds controversial to say it's almost unbelievable. Maybe it is. But what you saw in claims was a little bit different, and what we've seen in other data points over the last few months in the labour market has pointed into different directions as well. Let's take ISM manufacturing too. Take manufacturing, that picked up all of a sudden. Where did that come from? After being in contraction for 2 years or something?
I mean, stripping aside some of the other indicators, a lot of people are saying the seasonals get messy. A lot of people are saying that there are a lot of reasons to question whether this is a valid representation of a labor market really heating up. That said, a lot of people having the same questions she did. When you discount something outright, you can kind of get into trouble.
That report on Friday, I think, will spook a lot of people who were looking just for things to carry on decelerating on the payrolls market, on the payroll side of things and the headline number. Let's get you an update on stories elsewhere this morning. Let's get you a recap. Here's your Bloomberg brief. Here's your Hira Hackers.
Hi, John. Former President Donald Trump said he plans to impose a flat tariff of more than 60% on Chinese goods if elected. The comments signal an increasingly hawkish tone against the top supplier of goods to the U.S. Trump rejected criticism that actions would start a trade war. The U.S. has been China's biggest export market for more than 20 years, including over $500 billion in exports in 2022. McDonald's fourth quarter sales missed investor estimates as growth slowed, hurt in part by the war in the Middle East. Same-store sales rose 3.4% in the period, marking the slowest rate since 2020. Revenue also fell short. McDonald's became a target for boycotts after the war broke out over its perceived stance on the conflict, as well as its status as one of the most recognized American brands. Lionel Messi disappointed Hong Kong fans after he stayed on the bench the entire time during Inter Miami's 4-1 win over a Hong Kong team. Tickets for the match sold out within an hour, with the Argentine World Cup winner the star attraction. But Messi sat out due to a hamstring strain. The Hong Kong government said it was, quote, extremely disappointed with the organizer of the match. That's your Bloomberg brief. John?
I was disappointed too. I guess there was a promise that he was going to play, but if he's injured, he's injured.
He's injured.
He's injured, so, you know, what are you going to do?
Tickets are pretty expensive. You show up to see Messi. I don't know. I want to see Messi play.
If you go to the circus and the animals aren't there, you should get a refund, right?
Okay, is that really how we're going to describe this? I'm offended.
That's what AC Milan fans did back in 2012.
Okay, well then have him
when they sold Ibrahimovic and Thiago Silva to Paris Saint-Germain, and the season ticket holders demanded a refund.
Did they get it?
And I believe the fan group said that you shouldn't pay to attend the circus if the animals aren't attending. Something like that.
Isn't that kind of offensive?
I mean, sure, but I mean, they're paying fans, aren't they? You know?
I guess so.
If the Lions aren't there, you know, you're kind of disappointed, aren't you?
I hear you,
Basically.
You could do a meet and greet after.
All right, I'm told to move on, so let's move on. Up next, Red Sea tensions weighing on the energy industry.
We are adapting to those circumstances, and we are really focused on keeping our mariners, our people safe, and protecting our assets.
That's coming up next on the program, live from New York. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock. Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, we're down 0.25% on the S&P 500. Crude, unchanged at 72.28. Under surveillance this morning, Red Sea tensions weighing on the energy industry.
We are adapting to those circumstances, and we are really focused on keeping our mariners, our people safe, and protecting our assets, and doing everything from going around the Cape to swaps. But what we are trying to really focus on is making sure we honor our commitments to our customers through this difficult period.
Here's the latest this morning. Oil surging over the weekend after US and UK forces launched attacks against Iranian-backed Houthis. Prices turning lower after Fed Chair Powell reiterated a March rate cut is unlikely. Nadia Martin-Wiggin, director at Svelland Capital, joins us now for more. Nadia, let's get into it. Why crude is unchanged on the session? 72.32 WTI. Earlier this morning, it was lower on Brent and WTI. Why isn't this tension over the last 3 months plus driving and resulting in higher prices?
So, thank you. So, although the market is looking more dangerous in terms of physical flows, what we saw last week is that when this ceasefire was potentially announced in Gaza, the market just traded down and it hasn't recovered. And the market view had been that geopolitical pressure and difficulties in the Middle East weren't priced in, but then we had the sell-off and we haven't recovered as geopolitical tensions go higher. So I would say in the crude market, now we see that there's no geopolitical tension priced in, but the market is scared because what if we get a ceasefire instead of continued escalating tensions? So it's a wait and see situation.
Nadia, which is it though? Is it priced in or is it not priced in? If you do have geopolitical risk priced in, what would the price be if there were not that geopolitical hangover, as Anne-Marie has been talking about all morning, which is a correct question? And on the flip side, where would prices go should things ratchet up?
So I would say in the product side, when we look specifically at gas oil, heating oil, those cracks are really strong, right? And I would say that's where we have the geopolitical risk priced in. And that is because it's difficult to use the Red Sea right now. And normally it's refined products in the distillate space that are flowing from the Middle Eastern refineries up to Europe at a time when we're experiencing refinery maintenance across the Atlantic basin. So we can't have the US and Europe just produce more distillate. So that part is priced in. On the crude side, I would argue it's not priced in at all because we've traded down to a very comfortable level. And what is interesting is I would say in terms of the timing, a couple weeks ago, it looked like we were really having strengthening refining margins, concerns about the Middle East. Crude was looking like it was ready to stage a rally. And then on the WTI side, we couldn't break above, 77.40 and stay up there. We couldn't do the lower 80s for Brent either. And that's where we had this stalling and then this trade down.
Nadia, I want to ask you about two stories coming out of Saudi Aramco. One, that they're abandoning their plan to go after 13 million barrels a day of capacity, and also that Aramco may be reviving the share sale. Is it your sense that Saudi Arabia at this moment is just trying to go after funds?
Well, I think it's actually two different questions because it's a little bit strange timing. Banks are putting out that by stepping back on this major issue more shares in a company when you don't know the capex expectations, which of course would be announced at the end of March when they do their earnings, right? So it's a little bit strange in terms of the timing. On the other hand, the 13 million barrels per day, in our view, is a non-story right now. We see that Saudi Arabia is planning to transition and use less crude burn, the seasonal side in August, that is almost 1 million barrels per day, around 800, 900,000 barrels per day of internal demand that they use for crude. And instead, they could make that available for export. So that could be a 1 million barrel per day trade-off. In addition, we see that the U.S. supply chain is growing from strength to strength, and expectations are already starting to go higher in terms of what the U.S. shale space and the U.S. in general can produce this year. So the EIA has been talking about flat production over the entire course of the year, but we see upside to that level, driven, first of all, by the Permian, by what Exxon and Chevron were communicating in their earnings calls now, and also we see some additional production coming from the Gulf of Mexico, which has been historically actually very difficult for agencies to forecast accurately.
Nadia, we've got to leave it there. Nadia Martin-Wigan there as Felon Capital. Thank you. Crude this morning, 72.37, 72.36, basically unchanged. If you go back to the day before the terrorist attacks on Israel, we're down by 12.56% since then on crude, which is just amazing over the last 4 months.
It doesn't make sense. There's more hostilities, and yet the price continues to go lower, which I keep asking, if there wasn't any hostilities, would we be that much lower in crude prices? But just think about it. The world is flush right now with crude. The United States, Russia, Iran. Saudi Arabia is pumping 9 million barrels a day. They have capacity to go to 12. It's a big cushion.
Remember we used to talk about China and the slowdown there as one of the reasons?
Sure.
That too.
Just, yeah, I mean, just talk about narrative roulette. Yeah, exactly.
Yeah.
I mean,
that continues, okay?
I know.
Counting it down to the opening bout, 34 minutes away. Equities are negative by 0.3%. Coming up tomorrow, Larry Adam, Raymond James, Dan Morris, BNP Paribas, Deborah Cunningham, Federated Hermes, and Eli Lilly CFO, Anat Ashkenazi. From New York City, this is Bloomberg.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lyons deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From New York City, for our viewers worldwide, I'm Manus Cranny, in for Jonathan Farrow. So as the bond bears are reawakened, when will it really challenge the equity market narrative? The countdown to the open, it begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up on the show, Fed Chair Powell reiterates his cautious stance on rate cuts. The White House promises more strikes in the Middle East. And President Biden taking aim at Donald Trump in Nevada. We begin with the big issue. Fading hopes for that pivot to March rate cuts.
I think it's not likely that this committee will reach that level of confidence in time for the March meeting, which is in 7 weeks. Almost all of the 19 participants who sit around this table believe that it will be appropriate in their most likely case for us to cut the federal funds rate this year. We just want to see more good data along those lines. It doesn't need to be better than what we've seen or even as good. It just needs to be good. And so we do expect to see that.
Needs to be good, but not better. Mike McKee listened to the 60-minute interview. He brought us, of course, the jobs report and the upsum. So what's your take on Powell's latest remarks? Mike, good morning.
Good morning. I think Powell is just trying to reassure the American public that the Fed's on the job and that the economy is in good shape and that they are still watching for inflation and will act if necessary, but also could cut rates. Now, we get a lot of Fed speak this week, which could back up the chair. We start today with Austin Goolsbee right here on Bloomberg Television. And then on Tuesday and Wednesday, we have 4 Fed bank officials speaking each day. This afternoon, we get the senior loan officer survey from the banks. That might play into this whole NYCB question about regional banks. And then we move to the economic data, and it's a light week, very light week. Just ISM services today, basically jobless claims. And a lot of people are going to be watching the CPI revisions. This is something we'll ask Austin Goolsbee about, but last year they revised the CPI and revised away some progress on inflation. A lot of people think that was a one-off. We'll find out Friday if indeed it was. So the question then becomes, where do the markets go from here? Well, they finally seem to have believed the chairman. They've pretty much priced out March. And they've also brought down the odds of a May rate cut, although it is still in there. The question is, do they do May or do they wait until June? And if so, then how many do they do the rest of the year? Jay Powell, to finish it up, says that they're not going to let politics interfere. So they could be cutting rates again at the September meeting. Although that's still so far away, we can't even guess as to how close the markets are to being right.
Okay, Mike, thank you. As you say, the market is still presuming somewhere between 5 and 6 rate cuts. We'll squeeze them in before that election, will they? Don't miss Mike's interview with the Chicago Fed President, Austin Goolsbee. That conversation, 10 a.m. Eastern Time. What is the framework? What is the additional confidence the Fed wants before they can cut? Let's continue the conversation. Cameron Dawson of New Edge Wealth, Morgan Stanley's Michael Kushma join me now. So here we are. The short end of the bond market has jackknifed. It has reappraised, and listen to 60 Minutes in the jobs report. The equity market is stoic. So let me bring it to you first of all, Cameron. The stoicism of the equity market, are we in for a challenge to that, given the backup in yield?
Yeah, that's the big push-pull, because better economic data does help the earnings picture for equities. At least it makes it more likely that we can achieve what's already priced in of 10% for this year, 11% for next year for the S&P 500 earnings. But to your point, it raises the question on valuation, because valuations have expanded by about 20% since the October low, really pricing in this idea of an easier, more friendly Fed. So if the Fed doesn't deliver on those rate cuts, do we start to see downward pressure on valuations, which stand at 20.7?
Kashkari backing up, sort of raising the game on where the neutral rate might be, Cameron? Sorry, Michael.
Yeah,
Excuse me, Michael. Sorry, Cameron.
I think that's exactly right. I think for long-term bond yields, it's less about whether the Fed cuts in March, May, June. It's the cumulative amount we're going to get over the next 2 years. And that gets back to where that terminal rate is. And this is where the market is somewhat more pessimistic than the Fed. The Fed's talking about a 2.5% long-term Fed funds rate, which would justify lower bond yields over time. The market is actually thinking, 3.5 is where we stop.
Cameron, I always feel guilty when I get it the wrong way around, so let me give you this one. What kills Goldilocks? What interrupts Goldilocks skip through the woods?
I think it's earnings, and if earnings continue to be revised lower, one of the interesting things from this earnings season is that you've seen the S&P 500 earnings estimates get cut a little bit, but a lot more for the average stock. So if you look at the equal weighted S&P 500, what you're seeing is earnings have come down by 6-7% for 2024 estimates. If that continues, it raises the question of this diffusion mechanism of a better economy. How does it translate to better earnings? If you continue to see earnings estimates get cut, that puts valuations even higher than where they stand today, and that could be the hurdle that the economy or the market trips over.
So, Michael, let me take this back to you. Steve Major has a wonderful piece out this morning called Opportunity Knocks. Now, this is a game show that we all watched in the UK when we were young. That was a long time ago for me. It's a talent show, Opportunity Knocks. Winners will be decided by the public vote rather than a panel of expert judges. It's similar to the bond market. And essentially what Major is saying is that this backup in yield is something to be tempted into relative to T-bills, which of course, Cameron, will be the cash side of the equation where the equity markets are resting at the moment. But Michael, to you first of all, do you see this backup in yields as validating treasuries to bills?
I think that's true. One of the big negatives we've seen about the long-term interest rates, well below 4.5% or below 4% certainly, is that the opportunity cost versus shorter maturity assets, whether it's treasury bills or other short duration asset-backed securities which yield premiums over T-bills, that was a pretty high opportunity cost unless we were getting closer to the Fed, a meaningful Fed rate cutting cycle, meaning short rates will remain elevated relative to long-term rates. But from a longer term perspective, there's no doubt buying 5-year bonds, 7-year bonds, 10-year bonds, these are the best yields we've had in decades in terms of both nominal yields and real yields. So from that perspective, if you're willing to accept, I'm going to make 5% on a 5-year corporate bond and 7-year corporate bond, that looks pretty good from a long-term perspective. Our view has been made a little bit more cautious, simply that we could do better. The opportunity cost of staying in buying longer maturity bonds was a little bit high to pay before we got closer to the Fed rate cutting cycle, and we've been more sympathetic to the Fed's point of view than the market's point of view.
Okay, I'm just going to interrupt the conversation. We have breaking news coming through from Snap. They are going to cut 10% of the global workforce. The reason why I'm interested in programming to do this is a tech company on the real zeitgeist edge of tech in terms of the community that it serves. 10% of its global workforce is to go. They say a pre-tax charge of 55, double nickel to 75 million bucks. The global headcount will be cut by about 10%. This is adding to the various technology cuts that have come through. Cameron, let me just talk you through into this in the growth to value tech. Megatech did their job cuts last year. They are continuing. They were rewarded for those efficiencies. This is another example on the equity side of more pain to come in terms of job cuts.
Yeah, and the interesting thing about those tech job cuts is that it appears as if people who were laid off were able to get work rather quickly, as we never saw a very weak non-farm payrolls print, for example, or initial jobless claims never spiked up to a significant level, which just suggests that there is still demand for those kind of workers outside of tech or at different companies. It's a good question. We have seen challenger job cuts announcements tick up rather significantly to start the year, not consistent with recessionary levels yet, but it is important to watch if some of the weakness around the edges of the job market become more pernicious and actually point to a weaker job market ahead. Okay. Again, not enough data to say it's going to happen, but it's something important to watch.
Such a rich word, pernicious. I love it. Cameron, thank you very much. Cameron, Dawson, Michael, Kushma, stay with me. Absorb those job cuts and where we go next with the Fed. Let's go under the hood. The opening bell is just 30 minutes away. Abigail Doolittle is side by side with with me. What have we got?
Well, right here in the pre-market, Manus, we are, of course, looking at a small decline for the U.S. futures. One stock weighing Boeing, yet another setback for their production. They found more mistakes in their 737 production. Holes drilled in the fuselage. This was from a supplier, Aerospirit Systems, and it could delay the production, or the delivery, I should say, of up to 50 of those 737 MAX. Caterpillar, on the other hand, up 4.6%. They beat adjusted earnings by about 11%, driven by their energy and transport segments. They missed the revenue estimates, but investors seem to be looking past that. Net, the quarter and the outlook better than feared. And then Estee Lauder soaring up 17%, a 60% earnings beat. Revenues were better. They announced a restructuring that includes a 5% workforce cut. This stock, though, Manus, into today, down 65% from the 2022 peak. Investors clearly want this company to do something to right the ship.
Abby, thank you very much. Abigail Doolittle there. Coming up on the show, the U.S. vows more strikes in the Middle East.
So the president has been very clear from the beginning, which is that when American forces are attacked, we will respond. It began with the strikes on Friday night, but that is not the end of it.
Meanwhile, the Senate reaches a deal on Ukraine aid and the U.S. border. That conversation next on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
So the president has been very clear from the beginning, which is that when American forces are attacked, we will respond. It began with the strikes on Friday night, but that is not the end of it. The president is determined to respond forcefully to attacks on our people. The president also is not looking for a wider war in the Middle East.
Geopolitical tensions are simmering in the Middle East. In the U.S., senators are reaching a bipartisan spending deal to impose new immigration restrictions. That unlocks billions of dollars in Ukraine aid, with a vote coming Wednesday. President Biden indicates his support for the compromise, writing in a statement, "If you believe, as I do, that we must secure the border now, doing nothing is not an option." Amory Jordan has been parsing the weekend's press and moves. Amory, good to see you this morning. Let's start with the Middle East. It's not so much what the U.S. wants. I mean, they may say that they do not want to, they may be sustained in the campaign, but it's not open-ended. But it is about lighting the torch paper of the response mechanism.
Well, look, you see what the administration is doing is they're walking a very fine line. And I would go back to some of Jake Sullivan's comments over the weekend where he said this: what happened on Friday was the beginning. And these are those 85 targets they hit in Iraq and Syria, not the end of our response, and that there will be more steps, some seen, some perhaps unseen, all in an effort to send a very clear message. And we will respond in a sustained way. And then in the same breath, he said, I would not describe it as some open-ended military campaign. This is what is so fragile right now. The administration needs to respond. They want to deter or degrade Iranian proxy capabilities. They need to respond to those 3 U.S. service members that were killed in Jordan. At the same time, they want to keep a lid on the escalation in the Middle East.
Well, Iraq's response, this is an aggressive strike that will put the security in Iraq and the region on the brink of an abyss. One can say that's a natural response mechanism from the country that has been targeted. That's Bassem al-Awadi. But it just goes to show where we are. On the brink of an abyss is from the Iraqis. Finally, Ukraine aid. I mean, we got it last week from the Europeans into Ukraine. This, we understand, this week, a pivotal week in terms of a vote in the Senate on Ukraine aid. Extrapolate for me.
Well, it's not just Ukraine aid. The top line on the supplemental figure coming out of the Senate, we finally got the text last night after months of negotiation, is $118 billion. So yes, a chunk of that's going to be to Ukraine, but also $20 billion for the U.S. southern border, and then also aid to Israel as well. The issue is, Speaker Mike Johnson, in the other side of Congress, Manis, says it's dead on arrival. A lot of politics at play, given the fact that you basically have the former President Donald Trump breathing down these congressmen and women on the Republican side's neck, not wanting an immigration deal because they want to campaign on that to beat Biden in November.
Okay, a very, very febrile situation, as you said, bearing down on the Congress. Anne-Marie Hordem, thank you very much for being with me. Let's turn to politics now. Of trade. The former President Donald Trump speaking on Fox News on Sunday, threatening China with higher tariffs.
Now the Washington Post is saying that you're talking about 60% tariffs on Chinese goods. Is that in the cards?
No, I would say maybe it's going to be more than that.
It'll be more than that. Cameron Dawson, Michael Kushma back with me. Michael, this is the very essence of angst, isn't it? We don't know who's going to be in the White House, but this is on the campaign trail. This is higher tariffs. This is potentially adding to the inflation angst at the back end of this year and into next year.
I think that's true. You know, policymakers on both sides of the political spectrum have been pro-fiscal expansion. No one's a big deficit fighter at the moment. Maybe down the road, the pressure from the markets will be sufficiently high to deal with that. And I think that the tariff situation is as we've seen in the past, could be inflationary for the U.S. economy. Divert production to less productive areas, more costly areas, and be overall, problematic for policymaking.
Cameron, tell me this: is it too early? Is it too early for people to countenance how to shape a portfolio in the trajectory of a Trump administration? I mean, there's a long way to run, isn't there? There's like 9 months of this.
Yes, certainly. And we do know that there will be some correlation to Trump versus Biden baskets, depending on what the probability is of who gets elected. So probably too soon to completely price it in. And on the tariff front, we do think watching durable goods prices will be important because that's been a key source of the disinflation and now deflation over the last year in durable goods. So could you see higher tariffs start to feed into those goods that come from overseas and actually kind of exacerbate the issues with inflation again for the Fed and kind of get in their way of being able to cut interest rates as much as the bond market expects?
Well, let's just square it away. Michael, what do you want to hear from Goolsbee in just under 45 minutes? If you were sitting one-to-one with him, what would you ask?
I'd like to know about the terminal rate. Do they still believe that the U.S. economy is going back to its pre-pandemic levels, which was that secular stagnation kind of world, zero real rates as the equilibrium, or if we move to a new world, post-pandemic world, which is different from the 2010-2019 period, something like the mid-1990s, early 2000s, where real rates are higher, trade growth might be higher, et cetera.
To close off with you, Cameron, I mean, we're going to go through this challenge to the equity markets of spiking short-end yields, but looking at what Goldman Sachs are talking about, the Magnificent Seven, their fate depends on the ability to deliver growth. Do you see the propensity for the Mag 7, or do I come down to Mag 4, Alphabet, Microsoft, Alphabet and NVIDIA, to deliver the kicker of growth relative. Does the basket bifurcate, I suppose?
Most certainly. We do think it will bifurcate this year, and it all comes down to earnings growth. You contrast a name like Apple, which has seen its earnings revisions be effectively flat over the last year, but its valuation go up by 40%, with a name like Meta, which has seen its earnings estimates double over the last year, and of course it's had valuation expansion as well. So the winners this year will be those that have upside to current earnings estimates, can deliver on those earnings, while the laggards will be those that aren't seeing any change to earnings estimates or even have downside to those estimates.
It was pretty stunning. I mean, mega Meta on Friday, just under $200 billion. It blasted everybody else out of the water. How do they deliver against that value uplift on Friday, Cameron?
Yeah, I think it does create a high bar, and it's probably going to be a sideways stock from here over the very short term. Still very much in an uptrend, but the point is you've already reset expectations. You go to over a year ago and you had expectations that were so very low at the same time as you had a pretty easy bar to jump over from things like cost cuts. So likely the pace of returns will slow from here. It's not to say that they're not executing, but you've already priced in a lot.
Michael, just to close it off, do I embrace my inner bull on credit and just sort of say, look, this economy is strong, it lives long, it lasts, it's a no-landing scenario, dig in, buy credit?
I think you want to stay slightly overweight credit, yes. That the economic situation is Goldilocks for credit right now, and there's lots of historical episodes where credit spreads stayed very tight for extended periods of time because the fundamentals stayed strong. Now, if the fundamentals deteriorate, inflation stalls out, it's a different ballgame.
Okay, you're right. Let's see what Goolsby's got to say in just under 40 minutes. Cameron Dawson, Michael Cushman, my guest this morning, setting the agenda on Monday morning for risk. Your morning calls, and a little bit later on, we'll get Citigroup's Stuart Kaiser joining me around the opening bell. Why he's still positive, embracing his inner bull for equity risk, right here on Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
equity bulls are slightly unsettled, but don't be beguiled because below the line you've got NVIDIA picking up over 3%. This is the year where you're going to see a bifurcation between Magnificent Seven. They will break apart. Equities just a little bit challenged as you see yields pop to the upside this Monday morning. Time for your morning calls in terms of what the scribes of Wall Street are laying out for your risk agenda. JP Morgan downgrades Mattel to neutral, expecting limited upside with consumers facing mounting headwinds. Next up, MoffettNathanson downgrading Take-Two to neutral, pointing to a lack of positive catalysts ahead of Thursday's earnings. And finally, Citigroup upgrades Citizens Financial to a buy, seeing an attractive entry point following the recent declines. Coming up, joining me to discuss risk this Monday morning to set your agenda, it is Stuart Kaiser on the probability of, you got it, soft landing. That's what you really want to hear on the back of last week's data. Join me in just a moment with Stuart.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
Your kids, start them early, learning all about finance at the NYSE. Maybe they'll learn what challenges equity market risk at the moment. NVIDIA is rising, yields are rising, so the fundamentals of that equity bull market may well be challenged as you see short rates up by over 20 basis points. There is the opening bell. We're going to have a touch lower on these equity markets for this week. Let's hear what Goolsby's got to say in 30 minutes to Mike McKee. That's the state of play on the equities. One stock to watch at the open is Caterpillar. The shares are flirting with a new record high after topping out for the fourth quarter earnings estimates Abigail Doolittle is with me on CAT.
And in fact, Menace, I think that they are at a record high, the highest since this company went public back in 1980. It was a very solid quarter that they put up. It was the energy and transport segments that drove a big profit beat. They put up $5.23 in profits, adjusted earnings 11% better than expected. Overall revenues, though, slid. So this beat that we're looking at now up 6%. Let's see what that is the best day since. That really is driven again by the energy and transport. The outlook for 2024 good. Importantly, inventories are shrinking of their machines at dealerships. That said, there is a Baird analyst out there with an underperform rating saying that the flattish sales outlook would support the idea that a slowdown is increasingly apparent. Now, the stock just moments ago had been up about 2%. Now it's up 5.8%, the best day of the year, maybe having to do with the fact that a headline coming out of their call, the CEO saying that they have started to see supply chain constraints ease. The stock into today up on the year, up more than 25% over the last year. Investors seem to like what they are seeing out of Caterpillar.
Abby, thank you very much. And we're also keeping an eye tracking Boeing pretty much day by day. The shares are under pressure after the company find yet another issue with the 737 MAX jet. Ed Ludlow is with me from San Francisco. What's the problem now?
The problem now is misdrilled holes in 50 undelivered 737 MAX jets. And this is based on Bloomberg reporting on a memo from Stan Deal, Boeing's commercial chief, in which he explained this issue originated with a contractor or a supplier. And in the memo, Stan Deal did not name the supplier, but in this case, Spirit Aerosystems, which is down 3.6%, more than the decline we see in Boeing, came forward and said that it was aware of this issue with the fuselage and faulty rivet holes. But in the context of Boeing, you're completely right. We're down 2.8% on the stock. The stock down, I think, now more than 20% year to date. And this is just the latest issue with Boeing underscoring that this misdrilled hole issue, the riveting story, Manus, relates to 50 undelivered 737 MAX jets, which seems important to me.
Pretty concerning that in the production system, the very thing that the CEO is trying to take a hold of. But then, of course, deeper investigation delivers the reality here. More work for Calhoun to do. And thank you very much. Let's get back to the earnings slate. We've got Estee Lauder shares racing ahead. Now, this is after unveiling a restructuring plan. They're cutting as much as 5% of the workforce. Katie Greifeld is with me now. So this is more about the promises of a new Estee Lauder to come.
Exactly. Shareholders looking forward right now rather than backwards at the earnings. This is all about the restructuring plan, like you mentioned. Let's get into the details there. Beauty company said it would cut 3 to 5% of its workforce. The idea, the goal here is that it wants to make Estee Lauder a leaner and more profitable company so that it's more able to respond more quickly to things such as social media trends. We're talking about TikTok, Manus, and the like. So as a result, it expects between $500 million and $700 million before taxes in restructuring charges. But looking forward, Estee Lauder expects that the job cuts and other details of that plan will drive incremental operating profit of $1.1 billion to $1.4 billion. Now, remember, late last year, you had S&P Global Ratings say that Estee Lauder's costs had increased to between 55% and 60% of revenue. So clearly, shareholders are really cheering these cost-cutting plans. The share is currently up 16.5%. That is the biggest one-day advance since 2011, Manus.
Katie, thank you very much. Katie Greifeld on the Estee Lauder results. Stick with the cost cuts and the controls. Snap, as we broke to you a little bit earlier, is becoming just the latest tech company to announce job cuts, reducing the global workforce by 10%. Simone, the impact, good morning.
Yeah, Manus, well, its workforce at the end of September was 5,400 people globally. So if it still employs about that number of people, this would amount to 540 cuts. The company saying in a statement just this morning, just a few minutes ago, that these pre-tax charges associated with these cuts will include $55 to $75 million of severance and related cuts, also $45 to $55 million in future cash expenditures. However, most of these are going to be booked in the first quarter. It says these cuts, however, they may take some time to come through, could extend into the second quarter as the company deals with local laws. Snap saying these cuts are being made to, quote, best position our business to execute on our highest priorities. It's been facing that deceleration in ad revenue, as have many of its tech peers, and therefore cutting jobs and products that are no longer a priority. Look, just back in September, the company got rid of its augmented reality division that was marketing services for businesses. We're expecting earnings after the market tomorrow. We're looking at shares now down about a percentage point. So lots for the market to think about as it looks ahead to those financial results tomorrow, Manus.
Simone, thank you very much. Simone Foxman there. With Citi are weighing in on the markets. This is the agenda. We stay positive on equity risk after a busy week on a simple plot. A soft landing is more likely after strong labor data, and an FOMC still has a cutting bias. Stuart Kaiser is with me. They may have a cutting bias, Stuart, but he went on CBS, Powell went on CBS yesterday to really speak to the real economy. It's not coming as quickly as you thought, but for all the data still says to me, embrace your inner bull. Do not be frightened of this equity market. You concur?
Yeah, hey man. So that's generally our view, is that the hard economic data continues to print really well. You know, our focus is much more on the labor and services side of the economy, which remain really strong. And I think we got more confirmation of that, you know, on Friday and, you know, over the last kind of couple weeks with retail sales as well. So I think you just have to argue the underlying macro backdrop is positive for stocks, and that's where we want to be. I think, you know, a key takeaway from the FOMC was that the inflation data they've seen over the last 6 months, they believe justifies cuts if they continue to see more evidence of that. So, you know, they're clearly on a cutting bias regardless of the strength and growth that's coming through the system.
What injures equities? 3 cuts, not 6?
What injures equities?
Yeah.
Honestly, I'm not too worried about the number of cuts, to be honest with you. I think if we get any cuts, I think if we get cuts this year with an economy that looks like it looks like, then that's okay for equities. You know, I think we've talked about this in the past. Yeah. 2023 was a great test case for this, right? Where you had 100 basis points of cuts priced. Those cuts weren't realized. Equities did fine because it comes on the back of strong economic data. So as long as the economy holds in, I'm not, you know, too concerned about the cuts. It seems like the cuts aren't being priced out. They're being pushed out, which, you know, is incrementally positive as well.
That's a nice differential, pushed rather than priced. Talk to me about the flow. You've analyzed $500 billion worth of buy flows and how that breaks down between futures and vol along with CTA. What did you learn at the end of that analytic, and what should I take away from it?
Look, I mean, I think the takeaway is you've had a tremendous amount of buying in S&P 500. I think that's partly responsible for what we've seen this year, which is the index rallying, but below the surface, some kind of risk-off dynamic. So you're just getting a lot of demand, you know, at the index level. I would say, you know, our conversations with clients imply probably positioning kind of a 7 out of 10 here, which would be very consistent with the amount of buying we've seen. So I think the risk, if there is one here, is that, you know, equities are pretty fully owned right now. And who could be the incremental buyer of stock? So that would be, I think, the big takeaway is not too surprising to see the degree of buying because we've seen the rally. But, you know, where is that sort of next incremental buyer going to come from? And I think that's what, you know, some investors that are a little cautious here are asking that question.
Yeah, and I mean, I think this is the narrative, isn't it? You know, how much of the money market funds comes to the, not the rescue, but to the addition of the liquidity boost to the equity portion of the pie. When you look at, it's incremental this morning. Estee Lauder cuts jobs. Snap has just announced another 10% of job cuts in the tech sector. For technology, and I suppose let's start with the Mag 7. For Mag 7 to continue to deliver such huge upside. Look at Meta on Friday, up 20% in one day, under $200 billion. Can Mag 7 really deliver at that level again? Can you have a duplicate 24 to 2023 within Mag 7?
You know, our view is no, that you're going to need some broadening out in participation of the markets, and it's very much an earnings story. You know, one of the reasons we think Mag 7 was such the big leadership last year is that was a narrow part of the global equity universe that was providing earnings and earnings estimates revisions. You know, we think this year that broadens out a bit. You have more stocks and more sectors contributing to earnings growth. And for that reason, the Mag 7 sort of becomes a little less important from an earnings perspective, which means hopefully it can become a little less important from a, you know, from a price perspective. The challenge here, though, is you have, you know, the S&P tech sector is 20% of EPS, but 30% of market cap, right? So there is a trade-off here that it is important from earnings, but it's almost more important from a valuation perspective. So we do think it's a little bit higher bar this year for Mag 7, and we are of the view that you're going to see broader participation in earnings and thus broader participation in market performance.
Constantly we're trying to look for tail risk leave geopolitics aside for one moment and supply chain. One of the narratives that came through this morning with Katrina Dudley, who's with me on Bloomberg Brief, was this narrative that wages rising at 0.6% in the data on Friday is perhaps one of the bigger challenges and under-discussed challenges to sustaining margins at the level that we've seen in some of the stock narrative. Is that a tail risk, Stuart, for you? Is that worth talking about in your view?
Yeah, I think it's very worth talking about. If you think of the last year, you basically had companies who were able to protect margins at a time when they were also to take price, from the inflation. And this year, if you do get inflation slowing down and they're not able to push the price line, but they've increased wages, which are kind of sticky, on the bottom line, then does that mean you sort of get margin compression in a way that we didn't see last year? So it's a topic, investors are definitely kind of asking that question. We and the street, I still think, have double-digit EPS growth. So I think if we can realize that type of EPS growth, this won't be as big an issue. But if we do see margins starting to compress this year in a way they didn't last year, definitely a risk to the market. I'm not sure I call it a tail risk. I think it's more likely than a tail risk, but probably less impactful than a tail risk, if that makes sense. I think it could be a real headwind, though, if we see that play out.
Listen, I think there's a bunch of other things can be more material tail risk. I love the question you've got in the sheet, which is the pop quiz. Do you want to own equities more or less than this time last week? But of course, the risk is that there could be murder on the dance floor. I don't quite know what delivers Sophie Ellis-Bextor in the equity narrative, murder on the dance floor. But is this a bit? Is this a, you got to say it's so consensus, it's so stretched, or that's how it feels. Concentration risk, so long of equity, so long of Mag 7, so long of these markets. So what is it that makes you want to own equities more than it did a week ago?
I think for us, you had three big events this week. And if you were positive and optimistic like we are, you'd say, well, earnings, the price response was a little mixed, but we actually saw EPS revised higher. So clearly the underlying fundamental remained strong. The Fed tried to, play both sides of the fence in their messaging, but in the end, they're telling you they want to be cutting. And, the jobs data on Friday was exceptionally strong. You've printed on a revised basis 325K of jobs the last 2 months. You had very strong retail sales. I think, to your point, the wages is the biggest risk. But, this was a big test for markets, I think. And, there's obviously some blemishes here and there, but big picture, EPS remains strong. The Fed wants to cut, and the economy is chugging along. So in that sense, we still want to be long. And, as you know, if you have a big event and you get past that event without disruption, that removes a risk from the system, and we think that's going to get markets higher.
Listen, that jobs report on Friday, it might have reawakened the vigilantes in the bond market, but it has not, disemboweled the bulls in the equity market. They're stronger. Equity traders are a little bit stronger than those bond traders. Stuart, thank you very much. Now you can go and have a dust up on the trading floor at Citi. That is Citi's Stuart Kaiser with the very latest analysis coming up on the show. And the voters, guess what? They head to the polls in Nevada as the race for the White House heads to the West Coast.
You're the reason that Donald Trump is a former president. And you're the reason he'll make Donald Trump a loser again.
We'll have all the details on what to expect from tomorrow's vote. That's next on Bloomberg.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They'd made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
know one of the reasons you're here in Marrakesh and in Africa, because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next-era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal, and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
Bottom of my heart, thank you, thank you, thank you. You all are the reason why I'm President of the United States of America. You're the reason. You're the reason Kamala Harris is historic vice president. And you're the reason that Donald Trump is a former president. And you're the reason he'll make Donald Trump a loser again.
President Joe Biden on the campaign trail in Nevada this weekend. That's ahead of the Democratic primary on Tuesday. Now, the vote comes after Biden clinched the South Carolina primary. That was Saturday. Meanwhile, his Republican rivals, Donald Trump, Nikki Haley, will also face the votes in Nevada this week. This as Trump ramps up his plans for tariffs on China if he returns to the White House. Anne-Marie Jourdain rejoins me now. So, Anne-Marie, this is a weekend of rhetoric, interviews, and going back to some of the old playbooks of 16 and 20.
Right, when it comes to the former president, he gave this interview and he was asked about reporting in the Washington Post about if he would put a blanket 60% tariff on imports coming from China. This is also on top of the 10% tariff wall his campaign seems to be discussing, regarding really the United States of all global imports into America. And he said, actually, it might be more than 60% when you look at those Chinese tariffs. This is something that they're discussing. We need to remember Trump likes to use tariffs and talk about them also as points of leverage, but this is something he talked about, and he actually did when he was president, when it came to tariffs on China. But remember, Biden also kept that tariffs in place. But going forward this week, besides the policy, the politics will be in focus because we have a primary in Nevada. That is why President Biden was there. He's really trying to bolster support ahead of the general election in November in Nevada when it comes to Hispanic and Black voters. He wants to make sure that they show up and vote for him. He won Nevada in 2020, but our polling right now has Trump winning 48% to 40% in a hypothetical matchup in November.
Explain to me, as somebody that has arrived here, I'm not a voter, but the country goes to the polls. Everybody tells me it's the gas prices. Everybody tells me it's the economy, dummy. And yet we are on a daily basis focused on foreign policy. We are focused on on strikes in Iraq, retaliatory strikes there. We are focused on the Red Sea. And not really, Friday was a very tough day, great numbers, really, really good numbers. So does foreign policy really materially impact
voting in this country when you go to the polls?
Historically, Americans go out and vote for how they are doing economically, how they are feeling at the grocery store. As you mentioned, gasoline prices. But what could happen is if you have an escalation in the Red Sea that impacts crude prices, Manus, that could trickle down to gas prices.
Yeah, and we've looked at that. That's down 6% over the past 5 trading sessions. There's no war premium in that price at the moment, or escalation risk. True escalation risk, I should say. I should qualify that. Amri, thank you very much for being with me this morning. Amri Hordan setting the agenda of politics on the Open this morning. Data has just crossed the terminal. Mike McKee is with me. These are the PMIs. What have we got? They look strong.
They're strong, but a little bit less strong than they were last month. The S&P Global Services PMI comes in at 52.5 from 52.9. That's a little below expectations for an unchanged number. And the global composite for the U.S. comes in at 52 even, down from 52.3. These are kind of rounding errors, not a major change. Still suggests that the economy is in reasonably good shape. Top of the hour, we get the ISM Services Index. Will get a lot more attention than the S&P Global ones, and we'll be watching for that. We'll have that for you here on Bloomberg.
Quality of data, the lowest prices charged since May 2020. That's going to be a bit of cheer in the overall bond narrative. Mike, thank you very much. Mike McKee, those bond markets are on fire this morning. Yields are popping higher. We've got sector price action for you. Abigail Doolittle is with me. I wonder where you're going to come down, whether it's Estee Lauder or tech. Take it away.
Well, Menace, I'm going to come down on there are more sectors lower today than higher. Therefore, we have this small decline for the S&P 500. We have about 8 sectors lower, 3 higher. Starting off with those to the upside. Healthcare up about 0.8%. Tech and staples there also. Materials is down 2.2%. And when I dig into that sector, only 2 stocks are higher, whereas we have 1 stock, air products and chemicals in particular, down about 16%. We may dig into that later in the day. As for the last 5 days, this was surprising to me given Meta's big day on Friday. The 2 best sectors, or the best sector over the last 5 days, staples, that defensive sector, up 1.6%, and then communication services, barely higher, up 0.6%, and then you can see materials and real estate. Well, those are 2 of the down sectors over the last 5 days, Manus.
Yeah, that Meta move on Friday was just nothing short of spectacular and record-breaking. Abigail Doolittle side by side with me every day on the sector moves. Coming up, market moving agenda for you. It is just smorgasbord of Fed speak. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Powell went on 60 Minutes and reaffirmed to the American nation, now is not the time to cut rates. In the space of 2 trading sessions, you put on nearly 22 basis points at the very short end of the curve. This is about a repricing across the curve in terms of the narrative when and how much you might get. Now, that some juncture, this rip higher in yields is going to translate in a challenge into the equity markets. Right now, it's not exactly ripping equity markets lower. You're off 26 pips. This Russell, which is the belly of America, the breadth of America, is more under pressure. NASDAQ is down, snap-cut jobs. Estee Lauder promises jam tomorrow in terms of what they're doing on cost. Your trading diary looks a little bit like this for the week. It is shy. Chicago Fed President Austin Goolsbee joins the Bloomberg team at the top of the hour in less than 4 minutes. Here, the Atlanta Fed President Raphael Bostic later in the day. We flick over to Tuesday, and if you haven't had enough Fed speak at that juncture, we've got more. Mester, Kashkari, Collins, Harker, a quartet. And then, of course, it is UBS's numbers. What will the strategy and the earnings targets be from Sergio Motti at UBS? We get Yellen on Thursday. The Treasury Secretary testifies to the Senate, and that takes you through to Friday to the CPI revisions. What will they be? Will they be that dramatic? What's going to move the needle in terms of banking? It's the Armati interview. Can he outshine Andrea Orchel? Good morning.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. You're listening to Bloomberg Intelligence. Alex Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you can head over to youtube.com and get your look there. Coming up, we're going to take a look at some of the earnings coming up, some big earnings. But first, we're going to speak with Chicago Fed President Austin Goolsbee. He sits down in just moments with Bloomberg's Michael McKee. We'll bring that to you in just moments. But first, let's kick this thing off with Mr. John Tucker.
All right, and we're brought to you by Interactive Brokers. IBKR's redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit IBKR.com. Just in, the ISM Services Index coming in hotter than expected. That's the biggest part of the economy, 53.4. Maybe more importantly, the Services Paid Index way above expectations. S&P 500 15 points lower. That's down 0.3%, 49.43. The Dow down 231 points. That's down 0.6%. The Nasdaq 100 45 points lower. That is down 0.25%. Two-year yield 9 basis points higher. That's at 446. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate it. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. Big ISM numbers, right? The services sector, I know that's important for our economy, but boy, as John is just reporting some big numbers there.
So let me get this straight. The data is hot and inflation is still sticky. That doesn't feel like an economy that needs cuts at all imminently, sort of doubling down on what Powell said over 60 Minutes and Kashkari said as well about we can wait. They're going to have to.
I think so. I think that's the kind of the market's telling you here, looking at the 10-year Treasury. Let's look at the 2-year, up 9 basis points, 4.45%. The 10-year up 11 basis points, 4.13%. So I think that's the takeaway. So this is a great time to hear from a Fed president. Huh?
Yeah, and you really see the S&P rolling over also. We're now down by 0.3%. So a little gap down now at this point on that data. So good news, AKA bad news. Are we back into that scenario now where high yields do wind up impacting stocks? Friday, we didn't have that. Are we in that place right now?
Yep, I think so. Right now, let's go and listen to Chicago Fed President Austin Goolsbee. He is sitting down and speaking with our very own Bloomberg's Michael McKee. We're going to bring that to you right now.
And good morning to all of our Bloomberg television and radio audience around the world. I'm Michael McKee. Joining me now, Austin Goolsbee. He is the president of the Chicago Federal Reserve Bank, and we can get his reaction to an awful lot of news in the last 72 to 48 hours. First, let's dive right into it with last night's appearance. Chair Powell suggested again that March would be too early to cut rates. You wouldn't have enough data to justify that at the time. Do you agree with him?
Well, Michael, you know my thing is I never like tying our hands ahead of meetings when you got weeks of data coming through. It feels like the economy's been quite strong on the growth front. You got big jobs numbers, you got big GDP numbers better than expected. But at the same time, we've had inflation better than expected, too. If you look over the last 7 months, we've had 7 months of really quite good inflation reports, right around or even below the Fed's target. So if we just keep getting more data like what we have gotten, we're well on the, I believe that we should be well be on the path to normalization.
Well, I understand you don't want to tie yourself down, but is there really much of a chance of a March move? The markets think now 18%, and some people think that's even high.
Well, look, Michael, as I say, all we need to do is keep getting information like what we've been getting for the last 7 months, where inflation on a flow basis is absolutely under control and is in the range of our Fed target. And if we keep getting strong quantity numbers, that is to say jobs numbers, GDP numbers, growth numbers, while inflation goes down, in the conventional view, that's not really supposed to happen. So we'd have to be entertaining the possibility that we're entering a period like the mid to late 90s where you had productivity growth faster than expected, faster than trend, and that opens up some new possibilities.
Scott Pelley of CBS last night said that Powell suggested that rate cuts would likely be a quarter, maybe a half of a percentage point at a time. That doesn't appear in the transcript. Was a half percentage point cut discussed at the meeting?
As you know, we don't report on what's discussed at the meeting until the transcript comes out. Our standard way to think of it from the FOMC is somewhat like what's in the summary of economic projections, the SEP, which comes out every quarter. And the last time that came out in December, you saw that the median member of the FOMC thought there would be 3 rate cuts, i.e. 75 basis points for the year 2024.
Is there a situation other than perhaps a recession or some sort of market failure where you would consider a 50 basis point cut?
Well, look, I just think you get the data and you respond to the data in its totality. So I don't think it makes sense to speculate about hypotheticals of what would happen to make the rate cuts be different than what they have been in the past.
3% growth, 3.7% unemployment, 2.9% PCE inflation. The Fed discussing rate cuts. Is this a soft landing? Can you declare victory?
I mean, 2023, by the measures of the dual mandate, which is to say maximize employment and stabilize prices, that was a pretty good year for 2023, one of the better dual mandate years that we've seen in some time. You never want to declare victory. The central banker's job is to remain paranoid about everything because there are external shocks. There are a whole lot of things that can go wrong. But we definitely made progress on the side of the mandate where we had been failing. You know, the inflation rate was way higher than where we wanted it to be. And as I say, for the last 7 months, we've been at or below the 2% annualized rate. So we just need more months like that.
That's in the PCE index, but CPI, especially core CPI, the Cleveland and Dallas Fed's trimmed means, the Atlanta Fed's sticky wage price index have all been running faster and hotter than PCE. Is there an underlying inflation issue that maybe your measure's not picking up?
No, I don't think so. If we get down into the weeds, the different measures of inflation measure different things. And so categories like health insurance are better tracked in the PCE measure of inflation than they are in the CPI. And the PCE measure allows consumers to adjust to the prices and change their mix of what they're buying. That's why the Fed has chosen the PCE as where they want to get to 2%. The only thing I would like to emphasize is the Fed's goal is not 2% inflation on a Cleveland trimmed mean CPI or something like that. They make clear PCE is the measure that we're trying to hit 2%, and in CPI equivalent, it's going to be a little bit higher as a run rate on that measure.
Now that you've had time to think about it, what do you make of the acceleration in hiring over the past 2 months? Optimists say it shows the economy is very strong and maybe the Fed doesn't have pressure to cut rates. And pessimists say, can't be right, seasonal adjustment factors have fudged the numbers.
Well, it is a very important category. They did not fudge the numbers. That's crazy. But the thing that I want to emphasize, when you see big prints like the ones that we saw on Friday with big positive jobs numbers, there is a tendency from pre-COVID times to say, ooh, that must mean the economy is overheating. And I just want to make clear, at periods of positive supply shocks or improving productivity that's better than you expected, you cannot look at the quantities and determine whether the economy is overheated, because the same thing that's inflating the quantities is also bringing down the inflation. So you can, it affords new possibilities for monetary policy that are more positive than in a normal demand-driven frame. And we saw that in the mid to late 90s. And so we just got to be mindful in seeing these big, strong jobs numbers and big GDP numbers that they do not have to mean overheating in the traditional sense if the supply side is moving around.
The yield curve, and you could pick any of them, still inverted, started flattening, but then has now started inverting more again. Does that tell you anything about the economy? Supposedly, it signals a recession within 6 to 12 months, but it's been 14 months now, and so far, no recession.
Yeah, look, the thing about the inverted yield curve is a great predictor of recession when recessions are caused by the normal demand flows of aggregate demand. But all bets are off when the supply side starts going bonkers. And we've seen that going through COVID. And now as we unwind those deteriorated supply chain, we're getting labor force participation back up to healthy levels. You can get these inverted yield curves, I think, just from the anticipation of what folks think the Fed is going to do. If the Fed is cutting rates not because of demand shocks, which is what happens in the normal times, then the inverted yield curve doesn't need to be an indicator of recession. I realize there were too many no's in that sentence. I don't think that the inverted yield curve, as a rule of thumb, is really as applicable as a recession predictor. You certainly saw that in 2023. Yeah. Everyone was saying that it was very likely to be a recession, and it was nothing even remotely like a recession.
NYCB Bank, New York Community Bank, revived fears of regional bank issues last week. What are bankers in your district telling you about their situation? Is NYCB a one-off, or is it a canary?
Well, I was paid close attention to that, of course, because the Chicago Feds has the largest number of banks and financial institutions that we supervise, I believe, of all the Fed districts. The thing is, in this case, the bank had bought the assets of Signature, and that moved them up into a higher category where there's a little more scrutiny and some higher capital requirements. So thus far, that doesn't really seem like it's a commercial real estate blowing up or something like that. But of course, we're monitoring. As I say, this job of central banker is to monitor everything that can go wrong and to prepare yourself for it.
Well, one more question about preparing yourself. What are the bankers telling you about lending at this point with real rates going up, et cetera? Are they tightening credit? Are they tightening credit standards, making fewer loans, making more loans? We get the senior loan officer survey this week. What are we going to see?
Yeah, the beige book comes out every FOMC meeting where we talk to contacts, we talk to each of our reserve banks, talk to our own board of directors, as well as people out in the community. Over the last year and a half, you've seen a decidedly tighter credit market, for sure. Mostly, I think, just because the rates are higher. We had a fear in the spring last year with the collapse of Silicon Valley Bank and a few others that it would lead to a credit crunch. We mostly haven't seen more credit tightening than what you would expect just from the monetary policy and the rates, I would characterize. And that still feels like more of the same. And now you've had the long rates, which the Fed does not directly control. They've been on a journey. You know, they were up, then they're down, and we've fluctuated back and forth a little. Feels like credit remains tight, and especially at the lower part of the credit spectrum on both consumers, small business, and higher rate credits. they're getting a squeeze, and we hear that from our bankers as well as from the businesses themselves.
Austin Goolsbee, thank you very much for joining us. We would have called at our age, of course, the journey of the 10-year an e-ticket ride at Disney World. They don't charge that way anymore. Thanks for joining us today.
They don't. It's been a long time. Great to see you again, Michael.
All right, that was Chicago Fed President Austin Goolsbee speaking with Bloomberg's Michael McKee. I think the message, once again, consistent with what we heard from Fed Chairman Jay Powell last night on 60 Minutes. And then, of course, at the various comments from the other, most of the presidents. The economic data is saying they don't have to be in any rush to cut rates.
Not there yet.
Not there yet.
Not there yet, not there yet, not there yet.
And then the ISM Services number comes out today. The ISM Services PMI increased 2.9 points in January to 53.4, well ahead of expectations of 52. Gauge of prices paid surged on almost 1 year high. So it's pretty solid results on the back of this great GDP print we had last week and inflation data coming down. If you're the Fed, I think they've been pretty clear here.
Yeah.
They're just going to sit.
But then here's my question. Does it wind up pushing off cuts, though, even more? We're now market's now pricing in 4 cuts this year, as for WIRP on your terminal. Do we price hikes out more, a less aggressive cutting cycle, and then does that need to be fed through to asset classes? And what does that wind up looking like?
Yeah, that's a great question. I think the market's probably going to be trying to figure that out over the next several weeks. But again, as you mentioned, the WIRP function, we were at one point just recently last week, 6.
7 or 8?
Yeah.
6. Okay, 6 or 7.
Well, 6 this year, and then spilling to early next year.
Yeah.
So that's pulled back quite a bit. But I know you tuned in to see Taylor Swift last night. John Tucker did, but he had to watch.
I was
Chairman
waiting.
Jay Powell
I was
first
waiting
on
for
60
her
Minutes.
endorsement.
Yes, exactly.
I didn't see it. Do you guys see it?
Yeah.
You watched the Grammys?
Yeah.
I most certainly did not.
Sure, I did.
Okay.
But then my bedtime's early bedtime.
Your early bedtime.
Well, it's just Taylor Swift. She won, I don't know what, record of the year, I don't know, whatever, but she won a bunch of awards.
Yeah.
So, but it was pretty good. I don't know hardly
She looked
anybody.
very, very surprised, which
Right.
I have
Well,
to
yeah, there are a lot
question.
of really talented artists out there.
Yeah.
So, fair enough.
Yeah, but I was just shocked to see, Jay Powell on 60 Minutes. Like, really? You're going to use one of your slots on the Fed chairman when there's so much going on in the world and we hear from these people? And, does anybody watching 60 Minutes really care what the Fed chairman's saying other than us?
Well, I don't know. I think that's kind of the point. Like, who are they trying to reach? Like, my mom? Kaylee Lyons, who loves 60 Minutes, by the way. So there's that. Is that really where you're going, and why?
Huge fan of 60 Minutes. Yeah. So, but anyway, so we had that, and they were very cautious there. S&P 500 were off 0.6%. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. So the biggest part of the U.S. economy showing strength, the ISM Services Index beating estimates, and at the same time, the prices paid index that rose above expectations. So that's pushed yields higher. Stocks are lower. After the recent data and Friday's bang-up jobs report, Katrina Dudley at Franklin Templeton sees continued reason for optimism.
The American economy is doing well. We've been talking about Powell and about the Fed and ECB. They deserve that pat on the back because they have been successful. They've done what we wanted them to do, which is control inflation and keep people employed.
Right now, 9 of the 11 major industry groups in the S&P 500 lower. The biggest drag that's coming from materials, and that's where you're going to find shares of Air Products right now. That's down about 16%. They delivered guidance that was worse than feared. The leading stock in the index that belongs to Estee Lauder, 14% higher after announcing a restructuring that includes job cuts. The S&P 500, 33 points lower, and that's down 0.7%, 49.24 in the index. The Dow down 386 points. That's a decline of 1% right now. The NASDAQ 100, 120 points lower, and that's down 0.7%. The 2-year yield, 9 basis points higher, 445 there. The 10-year up 13 basis points. That's at 415. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right. Thank you so much, John Tucker. This is Bloomberg Intelligence. Alex Steele, Paul Sweeney. We are live from our Interactive Broker Studio here in New York City headquarters. You can also find us live on YouTube. We're going to tap all of our Bloomberg Intelligence analysts through all the hot topics and stocks throughout the next couple hours. They cover 2,000 companies in 130 industries worldwide. It's a lot.
Yeah,
they do a lot of work
started
there.
That business.
So, that was Paul, by the way, for those of us who don't know. So Caterpillar, let's go to one of them now. Caterpillar is up by 1.3% after reporting earnings that beat analyst estimates. Now, the stock was up more, about 5% earlier, but then the whole market's rolling over, so you can't blame it for also losing some of its flair.
High, though. Stock's at an all-time high.
So really good, and I love Caterpillar, not only for the oil, mining, and gas component, but it digs and does things, and that's a really good read for what the economy is actually doing. So let's get more with Chris Cellino. He's Bloomberg Intelligence Senior U.S. Machinery Analyst joining us. All right, what is your takeaway?
Yeah, I mean, it was a real solid print, despite the fact that we continue to see these really cautionary signs out there of slowing demand. 4Q results, broadly exceeded not only our expectations, but I think CAT's internal expectations as well. Pricing continues to surprise to the upside. The margin performance was quite good, particularly in their energy and transportation business. Retail sales to end users continued to hold up reasonably well. Orders came in better than we anticipated, and the cash generation of the business, remains very strong. So there's a lot of positives to take away from the report, and I think this probably dispels some of those, concerns over a more pronounced or near-term cyclical downturn, at least for the time being, as it appears, 2024 is really shaping up to be a little bit maybe more resilient than we had anticipated going into the print. That being said, we still think there remains risk, and it's mostly to the downside moving forward here. And we're really kind of cautious on the sustainability of this performance, especially as the macro backdrop begins to soften.
So what's the company saying about their outlook? And I guess my question, A, what's the company saying? And B, what's their lead time on, how far out can they see in terms of their orders and things like that?
Yeah, so they're looking at 2024 as kind of being more of a flattish type top line environment. Caterpillar is notorious for not giving much on the guidance, but they're kind of suggesting that top line will be relatively flattish. Volumes will be down next year, so this is going to be more of a pricing story, and particularly in the first half of the year as we get some of those carryover pricing benefits. And I suspect margins will come under some pressure, and we could see some modest contraction on the earnings line as well. In terms of the backlog and the visibility, it's above average. The backlog continues to be, remarkably strong. I think it was down 10%, but that's against a tough comp year over year. But you have roughly $27.5 billion in the backlog. I think one of the surprises of this report to us was orders. Implied orders only came down about 4%. So we saw the decline in the order rate moderate. So I think that's another positive sign that, we're not looking at this type of draconian type scenario for 2024. So
explain this one to me. What about the China factor? Because Air Products, as John Tucker was talking about, their chemicals business in China did terribly, and that's why the stock is down so much. I appreciate they're different industries, but still, CAT is very levered to China also. What did we learn about that?
Nothing incremental, right? So Caterpillar, China for Caterpillars, historically, it's been kind of in that 5 to 10% of revenues. 2023, this past year, we were below 5%. They're telling us that they don't anticipate much change in 2024. But if you're a cat bull, I think that's one of the catalysts that you could potentially look at, is that if or when we do get this China recovery, that would certainly bode well for cat.
Hey, Chris, I know, investors in these types of stocks, these industrial stocks, they're used to cycles, and they're probably saying, but God, we have to have a down cycle coming up here, yet the stocks are making all-time high here. But there's a lot of infrastructure work out there, stimulus coming out of the U.S. government, out of the pandemic. Isn't this going to make this cycle different, like it's going to be longer up for these companies?
Yeah, I mean, we hear that this cycle is different almost all the time, right? I'm a little bit more in the skeptic camp. Listen, North America was tremendous this past quarter and this year. I think it was the only region with positive growth on the top line. We saw 11% growth here in North America. A lot of that is largely driven by non-residential and infrastructure-related spending. So it's certainly been a tailwind, and I do suspect that still has some longevity to it here over the next few years. But there's a number of cyclical factors, to your point, at play here, and historically, this stock, when the backlog starts to come down, when orders inflect, that's not an encouraging sign for future performance.
But we also have lots of stuff like the IRA, we have the semiconductor bill, we have the Industrial Act sort of reshoring, all that stuff. We have learned from industrials that getting benefits from those pieces of legislation takes a lot longer than the market was expecting. Like just in the CHIPS Act, maybe we're seeing some stuff happening, and even that's getting pushed out, like we saw with Intel. What is Caterpillar saying about that visibility?
Yeah, so I think longer term, there is certainly an opportunity, particularly what they've kind of deemed this energy transition to, alternative fuels or electrification. There is going to be demand for mined commodities, and they anticipate that this shift will increase their addressable market. So no doubt, we do think there is a longer-term opportunity here. We think it's probably still many years out before we start seeing, more tangible financial impact from some of these. Infrastructure bill is the more near-term impact that we've seen and the results this far. So we think that's probably still a little bit longer down the road, and somewhat difficult to quantify at this juncture.
So, Chris, you follow all these big industrial companies in addition to CAT. I mean, Oshkosh, Cummins, Volvo, Packard. What are those big companies that are so skewed and so exposed to kind of the industrial side of the economy? What are they kind of telling you these days?
Yeah, so if you think about all the machinery verticals, we were essentially at peak cycle in 2023. Almost all those markets, we expect volumes to be down in 24, some holding up better than others. But I think one of the things that we continue to hear is that this downturn looks a little bit more modest and short-lived than what we have seen historically. I might say the one caveat to that being on the ag side, as we continue to see crop prices and farmer incomes under pressure. But at least at this point, we see on the commercial vehicle side being a little bit more modest. And even on construction equipment, there's a number of offsets to the more traditional cyclical headwinds. So again, not looking at this as some kind of a steep or severe downturn. It just seems to be much more modest than what we've become accustomed to.
So Paul was just talking about, real quick, the record high for the stock. Attractively valued? is that the right, how much more upside based on all of this?
Yeah, so I mean, if you think about, I think they trade roughly, 15, 16 times this year's earnings. historically, this is a stock that's traded between 10 to 12 times peak earnings. Trough, you're north of 20 times. So it's just off peak levels. So, it seems somewhat reasonable to us relative to historical valuations.
All right, Chris, thanks so much for joining us. Appreciate that. Chris Ciolino covering all the industrial stuff for Bloomberg Intelligence, along with Karen Ubelhart. So they cover all that stuff. They got it wired.
They're huge. I love me industrials.
Yeah.
I think they're that's where you're going to go to figure out the economy, especially for the chemicals. I was mentioning air products because they're like an earlier cycle kind of play. So if they're struggling, then you can realize where areas they're struggling, that growth is going to struggle too. I think it's really important.
Yeah, I mean, you look at cat. When I think of cat, I think of construction.
Yep.
And when I think of deer, I think of the farmer.
Yep.
How's the farmer doing? The farmer had some really, really good years, and when they have money in the pocket, they spend it.
Yes.
Buying tractors and stuff.
Yes, which hence for Caterpillar. Although apparently the cattle, did you know this, that there's a big cattle problem in the U.S.?
I didn't know that.
That's why beef is really struggling. Like if you look at Tyson, there's just not that much cows.
Aren't they making more cows?
There's not that much. There's a drought of cows.
Why is there a drought of cows?
Yeah.
Because there's a drought.
There's a drought, so there's feed and there's the cost of, I get it all kind of.
In some sections of
and
the
also
country.
takes longer than like replanting corn or something.
How long does it take?
I don't know.
A cow?
I don't know. John Tucker?
We
This
had a
feels like I
cow
should know.
on the farm.
Of course you did.
See, he knows this. I
was
knew.
I was not a cow fan. Not very smart, filthy animals,
But if you're a rancher,
but they taste good.
But they taste good, very good. All right, S&P off 0.6%. Right now, let's head down to Washington D.C. to get world and national news with Amy Marsh.
All right, thank you, Paul. The Senate has finally taken the wraps off its bipartisan deal, tying billions of dollars in Ukraine aid to tough border policies. Both Senate leaders Chuck Schumer and Mitch McConnell support the $118 billion compromise. It still, though, faces a tough road in the House, as we learned from Bloomberg's Laura Davison in Washington.
You've already seen conservative Republicans, particularly in the House, say, look, we're not going to vote for this deal. They're egged on by President Trump, says that they should reject any deal that's less than perfect, holding out for a perfect deal. So this is where you really see election year politics playing into legislating on Capitol Hill.
Bloomberg's Laura Davison reports House Speaker Mike Johnson denies the former president is calling the shots on the issue, telling NBC's Meet the Press, quote, I call the shots. Iranian-backed Houthis vowed to respond to U.S. and British-led airstrikes after dozens of targets of the Yemen-based rebel group were struck over the weekend. An agreement to pause the Israel-Hamas war and free civilian hostages captured by Hamas now is not imminent. That, according to U.S. National Security Advisor Jake Sullivan. More on that situation from Bloomberg Opinion's Mark Champion.
Well, there are talks, going on, as we know, and they're going to be really difficult. At the moment, what the Israelis and the Americans are saying is that the ball is in Hamas's court, that the Israelis have made a proposal. It's now up to Hamas to respond.
Bloomberg Opinion's Mark Champion. The Supreme Court will hear arguments this week on Thursday about whether former President Donald Trump should be removed from Colorado's primary ballot. It is a case which will have implications for other similar efforts around the country. The argument is to keep Trump off the ballot is that he violated the Constitution by committing insurrection on January 6, 2021. Global news, 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. In this Bloomberg Business Flash, we have yields. They are higher. Stocks are lower. Fed swaps almost wiping out the odds of a March interest rate move. And the chances of a May cut, they've also been reduced. The Institute for Supply Management's overall gauge of services, remember, that's the biggest part of the economy, increased the most in a year. And then the group's metric of prices paid for materials, that jumped the most since 2012. Meantime, you just heard from Lori Calvasina at RBC Capital Markets. She is not ruling out a pullback.
Anytime you start thinking about pullbacks in the U.S. equity market, you know, kind of a garden variety, something that's typical and nothing to get too concerned about, would be anywhere from, say, 5% to 10%. And that's, you know, really kind of looking at an outlier.
10 of the 11 major industry groups in the S&P 500, they are lower right now. Healthcare, the only group that's higher. And Caterpillar, the best performing stock right now in the Dow Jones Industrial Average. S&P 500, 33 points lower. That is down 0.7%. 49.24 on the index after Friday's record close. The Dow Jones Industrial Average down 359 points. That is a decline of 0.9% right now. The NASDAQ 100, 155 points lower, and that is down 0.9%. Two-year yield is 10 basis points higher. The 10-year is up 14 basis points. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
It's an ugly equity tape. This is what we're looking at. And if you report earnings that aren't great and you kind of roll over into this tape, not good. Just look at McDonald's, down by almost 4% around the lows of the session. Alex Steele, Paul Sweeney here at the Interactive Broker Studio right here in New York City and live on YouTube, where we bring you all the best from Bloomberg Intelligence, where they cover 2,000 companies and 130 industries. So let's get to it. Michael Halen, Bloomberg Intelligence Senior Restaurant and Foods Service Analyst, joins us now. Michael, McDonald's down the most since 2022. What do you think of the quarter? What was the big takeaway?
Yeah, it was a weaker quarter than most expected, for sure. Sales growth was kind of weak. You know, they cited the impact from the Israel-Hamas war, and obviously that hurt results in the Middle East, but also in Muslim countries like Malaysia and Indonesia, and then also countries like France that have a large Muslim population. It may have impacted sales here in the U.S. a bit as well. There were some calls to boycott the brand right after the start of the Israel-Hamas war. Those kind of went away in December and January, however. So there could have been a mild impact in the United States as well. And then in terms of key takeaways from the call, you know, they don't expect their developmental markets where the Middle East is located to improve really until the war ends. And they cited some consumer weakness in the United States, which they have before, right? But it seems like it may be spreading in terms of, you know, just low income consumer weakness. You know, it sounds like their customers right now are managing their guest checks.
Hey, Mike, I'm just looking at the PGEO function on the Bloomberg Terminal, and I see that roughly 60% of the revenue comes from franchise-operated stores and about 40% from company-operated stores. How did they make that decision about when they go to a particular location, whether to franchise or own it?
I think a big part of it is return on investment, right? So if the returns on the investment are very strong, they typically want to hold on to those stores or develop stores. You know, they'll do some store development in the United States and in their more established markets, but it's going to be a small percentage of what they're doing. Going forward, you know, most of their growth is going to be, you know, done by their strong franchise partners, particularly in China and some of these other very fast-growing markets.
Talk about the input part of the situation in terms of their costs, in terms of their labor and all that kind of good stuff.
Yeah, so you know, inflation is easing for them this year. but it's still probably higher than normal.
Cows.
They're looking at
It's cows, man.
Yep.
Cows.
That's part of it. For sure, beef and dairy costs are expected to be higher this year. So, but they're looking at a low single-digit commodity inflation in the United States and abroad. Abroad had Europe had very high inflation last year, and that's going to settle down a bit. Labor inflation is going to continue to be higher. And a big part of that here is, in the U.S., they're California, April 1st puts in the $20 minimum wage for fast food workers. And so that's going to impact some of their stores, primarily their franchisees, however. So they're still seeing, higher inflation than, we had in the 20-teens for sure.
Hey, Mike, I look at this stock and, I need to pay a 22, 23 times earnings for this stock. What am I really getting? Is it something more than GDP top line growth? What's really the call behind this kind of stock?
Yeah, well, with their global growth, they're going to probably grow higher, quicker than GDP. What you're buying with a franchise business is, pretty stable and predictable earnings growth, free cash flow growth. There's not a lot of operating leverage in the model, and so they're asset light, and so they can lever the business up and return cash to shareholders pretty aggressively. So it's definitely an attractive model, especially one with the strong top line growth like McDonald's has, and they're also. Most investors consider them slightly insulated against a recession and slower economic times, and a big part of that is the value that they offer. During the Great Recession, they outperformed the quick service industry pretty significantly, acquired a lot of market share during that time, and so investors feel there's some safety investing in McDonald's versus some of the other restaurant chains out there.
But Mike, that confuses me with what you said about customers watching their checks and their items and what they're buying, because you would think if things are hard and people are struggling that you would get more value and people would go to McDonald's, but you were mentioning how in general people are watching their money more, so they're not. How does that kind of square?
Yeah, so what we've seen is a lot of traffic deterioration over the last couple of years because price increases have been so aggressive and people's spending is being pinched, right? But the thing about quick service, they're in the lower end of the market, right? And so they'll see during an economic slowdown, they'll see higher and middle income consumers kind of fall into their bucket. They'll spend less at higher cost, full service occasions, and they'll visit McDonald's more often. Whereas a lot of the low income consumers will kind of fall out of that bucket and decide to opt for the grocery store more often. So they'll lose some traffic on the low end, but they'll probably gain some with some of the middle and upper income consumers.
So Mike, who's really their competition these days? When I was a kid, it was Burger King and Wendy's, but now there's so much more out there. How do you kind of slice it?
Yeah, it's the restaurant business, man. It's so fragmented. There's competition everywhere, man. To your point, convenience stores, grocery stores, food trucks, you name it. Still, primarily, their biggest competition are the fast food restaurants that are located closest to them. So it depends on the market. California, Jack in the Box is number 2. On the East Coast, Burger King is number 2 in most markets, I'd say, in the United States. Wendy's obviously is a big competitor of theirs, but also, places like Chipotle and Shake Shack, are also all competing for restaurant dollars with McDonald's. But, we don't look too closely at market share in this business because it is so fragmented. And, I don't really like total addressable market in restaurants because nobody's going to eat at McDonald's 3 times a day, 7 days a week, so.
Isn't there a movie on that? Was there a documentary that's doing that?
There was. Yes, there was.
All right, hey, Mike, we got to leave it there. Mike, thanks a lot. Mike Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst joining us. So I had Smash Burger for the first time a couple weeks ago.
Good?
Yeah.
Yeah.
But honestly, I can't tell the difference between all these different fast food. It's all the same, right? They're all like burgers, shakes, and salads.
Yeah, but there's different tastes and stuff like that. We'll have this conversation until the cows come home, literally.
Literally, the cow. Yeah. That one cow that John Tucker
French fries, I'm still putting the best French fry at McDonald's.
Mm-hmm.
I'll die on that hill.
We named it Moo Moo. So you could have been eating.
Did you
my
name that as a
moo-moo.
child? I can see Little John Tucker.
Yeah.
Little Johnny Tucker, right? The
That
farms of
Al-
New Jersey.
That
I can
Alex then ate.
S&P 500 off 0.7%. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker with a look at some of the companies that are making news today. And let's start with Boeing, another manufacturing slip-up. Boeing has found mistakes with rivet holes in the fuselage of 50 undelivered 737s. Now, the extra time required for inspections and repair work could mean delays. Their supplier, Spirit Aerosystems, is believed responsible for all this. Now, there have been a string of manufacturing lapses at Boeing, including that near-catastrophic panel blowout last month. The Federal Aviation Administration has stepped up scrutiny of Boeing and has also capped 737 production until the quality improves. And Bellwether Caterpillar, one of the world's largest manufacturers of heavy machinery, batting away concerns of a global economic slowdown. They reported higher fourth quarter sales in the energy and transportation businesses. That helped them post a profit that topped analysts' expectations. Snap reducing its workforce by about 10% worldwide. So they're joining the chorus of tech companies that have announced fresh rounds of cuts since the start of the year. Well, Snap has been working to offset a deceleration in ad revenue, coping with the slump by cutting jobs and culling projects that are no longer seen as a priority. And then you have those videos of disastrous layoffs accumulating on TikTok. They're prompting companies to seek help in delivering the bad news. More people are sharing intimate details and recordings from workplace conversations that used to transpire behind closed doors. TikToks about getting laid off are now routinely dissected in public, from CEOs' mea culpa memos to awkwardly timed announcements. So you can see that on TikTok, I guess.
Yes.
You got to be kind when you lay people off.
John Tucker, thank you.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, looking at these markets here, the S&P 500 is off about 0.7%. The Dow's off 1%, and NASDAQ is off 0.8%. Yields moving higher here sharply. The 10-year Treasury is up 14 basis points. Let's call it 4.16% here. WTI crude oil off about 1%, $71.60 a barrel. Gold, $20,016. That's off about 1%. And Bitcoin, it's down just slightly, 42,600 for the cryptocurrency. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Morris.
All right, thank you, Paul. The White House says more strikes are coming against Iranian forces and proxies after a barrage of attacks over the weekend. National Security Advisor Jake Sullivan says the U.S. response to the deaths of 3 American soldiers is not an open-ended conflict. Norman Rule is with the Center for Strategic and International Studies.
The strategy appears to be we respond to the actions and the capacity of our adversaries. So in essence, what you're going to see is a heavy intelligence-driven program. Now, the proxies are going to hold back in the near term, other than symbolic attacks, because they don't really know what the U.S. is going to do.
You can get that full conversation on the Surveillance podcast. Former President Donald Trump says he might impose a new tariff on Chinese goods if elected. Bloomberg's Brian Curtis has that story.
Trump told the Washington Post he might impose a 60% tariff on Chinese imports. He told Fox News Sunday Morning Futures it could be even more.
I'm not looking to hurt China. I want to get along with China. I think it's great, but they've really taken advantage of our country, and we turned it around.
The comments add to a long list of concerns for investors of Chinese assets. Goldman Sachs has said that a Trump re-election is among the most frequently asked questions. Trump also weighed in on Nippon Steel's move on U.S. Steel.
U.S. Steel. You know what a name that is? That's the most important name. 50 years ago, there was no company like U.S. Steel. Now that Japan is buying it, I don't think I'd let that deal go through, by the way.
Donald Trump on Fox. In Hong Kong, I'm Brian Curtis, Bloomberg Radio.
Women artists were the big winners at the 66th annual Grammy Awards last night. Miley Cyrus won her first 2 Grammys for Record of the Year and Best Pop Solo Performance. Taylor Swift also took home 2 awards for her Midnights album. And Joni Mitchell made her debut performance on the Grammy stage at 80 years old. Joni Mitchell also won Best Folk Album for her live album, Joni Mitchell at Newport. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg. Paul and Alex.
All right, Amy Morris, thank you so much. We appreciate it. Alex, my youngest of 4 is a freshman in college. He did not take the ACT or the SAT because the schools didn't require it, and his older siblings, all who had to take it, were very upset. They're like, hey, how come he doesn't have to take it? We had to deal with the stress. That's because a lot of schools back in the last several years have saying we don't have to do it. Now, maybe a little bit of a switch back. Dartmouth College said it would require standardized testing again for applicants to the Ivy League college, the second elite U.S. university to reverse a trend about assessments that were halted during the pandemic. The school said the resumption is backed by evidence that it can help attract more diverse candidates at a time when colleges are trying to assess admissions after the Supreme Court last June said they can't consider race as a factor. While most elite schools haven't decided about a permanent return to testing, the Massachusetts Institute of Technology announced 2 years ago that it would reinstate the mandate.
I have a couple of feelings about this.
Yep.
One, my best friend's husband tutors for SATs, so I'm really happy for him because he was really having to try and revamp his business, and that was pretty tricky. On the other hand, I still don't really get how this is a sign of intelligence, but maybe that's just if you have 10,000 applicants, you got to find some way to weed through. I don't know. My daughter's in 4th grade, so we haven't gotten to like that testing part. There's state testing, but that's where we're at right now.
Yeah, it was. I tell you, as a parent who didn't have to deal with managing it and the stress,
so much nicer, right?
So much better, But again, I won't see how it goes. But the move reignites the debate over whether testing helps or hurts low-income students. Testing had been criticized for favoring wealthy students who can pay
for the tutor,
test
like
prep
my best friend's husband.
Exactly.
Yeah, exactly.
Applications soared when colleges dropped the test during the pandemic, which had closed test centers. So we'll see how that plays out. But Dartmouth there and MIT, a couple pretty good schools as far as I know. So we'll have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, more stuff coming. Anthony Nieves, chair of the ISM Services Business Community on ISM Services data out today. Pretty darn strong. Plus Ben Glicklich, CEO of Element Solutions, to discuss the latest on the tech sector, including semiconductor demand. And then we're going to talk some luxury with only the very best voice out there on luxury. Deb Aiken, she's a Bloomberg Intelligence senior analyst, covers the global luxury products. I mean, some of the swag she brings home from some of these analyst meetings is pretty sweet.
We're in the wrong gig. I'm in the wrong gig.
I know, exactly. All right, let's kick this whole hour off with Mr. John Tucker.
All right, let's start off with stocks and bonds, both lower in price after that hotter than estimated economic data. The service sector, that's the biggest part of the U.S. economy, expanding in January by the most in 4 months. The metric of prices paid for materials, that also jumped, showing that costs are rising at a faster pace right now. As we look at the more policy-reactive two-year yield, that's 11 basis points higher. That's at 447 right now. Meantime, the recent rally probably going to broaden out to less expensive stocks. At least that's according to Ed Yardeni of the Yardeni Group.
I think there's lots of reasons to believe that the economy is doing quite well. I think the Fed has clearly signaled they're done raising interest rates, and they at some point may be lowering interest rates. And so and of course they're extremely cheap.
And in the S&P 500 right now, the leader in terms of index points, Estee Lauder, that is up 13%. They're restructuring, cutting jobs, and Air Products, that's the laggard right now after their disappointing results. That stock down close to 16%. Overall, S&P 500, 35 points lower. That's down 0.7%, 49.23 on the index. The Dow Jones Industrial Average, 409 points lower. The NASDAQ 100, 139 points lower, and that's down to 0.8%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio. We're also streaming live on YouTube, so you can head over to youtube.com and search. Where we can search Bloomberg Radio, Bloomberg Podcast, all that kind of fun stuff. That's where you will find us. So Alex and I were talking earlier this morning at around 10 a.m. Wall Street time. ISM released some really good services data. So let's get right to that with Anthony Nieves. He's the chair of the ISM Services Business Committee. He joins us via Zoom. So Anthony, again, the ISM Services Index came in at 53.4. That's the headline. Consensus was 52, and the last period is 50.6. Big jump there. Can you walk us through that?
Certainly. When you look at the composite index, it was driven by new orders increasing 2.2 percentage points from the 52.8 to 55.0, and employment rebounded nicely. We contracted last month in December, was attributed to the pullback. The pullback was attributed to the fact that the cycle time of hiring with the holidays and vacations and whatnot, and that rebounded nicely to 50.5, up significantly 6.7 percentage points.
Hey, Anthony, great to see you. We love this data. I love the instant analysis from it. It wasn't like all sunshine and rainbows, though. Walk us through sort of what areas of services did well, what area of services may be still contracting.
That's a great question. And you look at the composite index and also prices were increasing 7.3 percentage points, 56.7 up to 64. Food prices still remain very strong. That I feel has impacted the Fed looking at interest rate cuts. Our respondents are telling us that they'd love to see continued cuts in the interest rates. But the bright side of that, there's capital spending, new projects are being released. When you look at the top 5 industries that contribute to GDP overall, real estate, rental, and leasing is still contracting. The increase is coming from professional, scientific, technical services, as well as healthcare, social assistance, very strong this month.
So, I mean, the services is 70% of our economy. I mean, I can't see a GDP contraction scenario coming out of, we get data like this. I mean, are you guys at the ISM, what's your economic call here?
When we look at this monthly report coupled with the semi-annual forecast, what our respondents indicated to us that the first half, especially in services, wasn't going to be that robust, but the second half was going to be better. I feel we're slightly ahead of the trend. And to your point about, GDP growth, I think, what was it, 3.3% last year? When we look at the composite index this month, annualized, it's at 1.5. And if we see the second half, as they indicated to us, being stronger, we'll have this incremental growth continue. It'll be a good story for the services sector.
So when we come to the prices paid, though, I mean, it's pretty staggering. Jumped the most since 2012. Was this a supply story or a demand story? Because we have seen a lot of supply chain snarls, et cetera.
Well, we definitely see that it's a demand issue, especially with new orders. Even though it looks like, at 55, it's middling as far as the growth, 2.2 percentage points up in the 52.8. But definitely it has some constraint on transportation, and that was indicated to us by our respondents. They said that there's challenges with the Suez Canal, with the conflict over in the Red Sea, as well as the Panama Canal. We're seeing the capacity has reduced to less than half of what it was, based on the issues with being able to fill up the locks with the water shortage over there.
Interesting.
All right, so what are you looking for going forward here, just to kind of get a sense of the consumer? Is it the labor market? Is that the primary driver here? Or what else kind of, from your perspective, influences the consumer?
Well, the labor market and employment, you look at it at 50.5, that's a really interesting story there. It continues the same trend and pattern that we've seen. Certain industries, they're still going through job cuts, whereas others are finding competitiveness in the marketplace and trying to recruit and hire applicable workers. But overall, it's really coming down to where is it driven from, and right now, it seems to be those 2 industries that I mentioned previously, professional, scientific, technical services, as well as the healthcare and social assistance.
All right, before we let you go, Anthony, before we let you go, is this an economy that has the risk of actually running hotter if you're just looking at the responding data here?
Not really, because looking at it at the 53.4, it's not in any risk of overheating at this point.
Hey, Anthony, really great to get your perspective. Thank you so much. Interesting, Goldilocks. I mean, at the end of the day, prices pay a little bit, but this is definitely a Goldilocks story. Anthony Nieves, he joins us, chair of the ISM Services Business Committee. It's really nice to get the details of the big data points. It is moving markets. We're off the lows of the session, but we're still down by 0.671% on the S&P.
Absolutely. So we go to the sources when we can. Let's switch gears here. Let's talk about a real company out there, Element Solutions. Ben Glicklich joins us. He's the CEO of Element Solutions. He joins us live here in our Bloomberg Interactive Broker studio. We appreciate it. You're based down in Fort Lauderdale?
Yeah, Miami.
Nice.
Why are you here? Be in Miami.
Well, because is it going crazy down there? What is it? I mean, is it just nuts with all these people coming down?
There's a ton of energy. It's a great place to live and work. For better or worse, I'm on the road 3 weeks out of the month because the business is very global.
Just for background, Paul wants to be there. He wants to move to Florida. He wants to do the show from there.
Exactly. All right, talk to us about Element Solutions. I know you guys are just tell us about your company, what you do, and then we'll go from there.
Great. So Element Solutions is a provider of chemical technology that enables high-performance applications. So our materials and process solutions are used in manufacturing high-value products, from semiconductors to smartphones to high-performance automobiles.
So your customers are technology companies primarily?
So our customers are technology supply chains.
Technology supply chains.
We're selling to printed circuit board manufacturers, semiconductor manufacturers. It's a very fragmented below the original equipment manufacturers that make the smartphones and the cars. So we're a critical enabler of their technologies, but we're not selling directly to them.
So you're not making like plastic for the end user kind of thing either, because usually like what I love about chemicals is that really closed early cycle read on the global economy, right? Like what Air Products is doing when Relationship telling me about China. That's not you guys.
So we're selling critical components that enable performance of high value products. So we do have a read on what the next generation smartphone is going to look like. We have a read on trends in automotive and other electronics end markets.
How did you find yourself to this business?
It's a fantastic business.
I'll take your word for it, but I mean, it's not something that I would have thought about just off. You have to have been dropped in there somehow.
So better lucky than good, I would say.
Okay.
I partnered with our chairman, Sir Martin Franklin, who's been very successful building multiple different businesses. And together, through acquisitions, we built this portfolio of market-leading chemical
Now, it doesn't,
technologies.
when I think chemical company, I don't think South Beach.
It's true.
I think like Cleveland. So, what are you doing in South Beach? Not that, or Miami. No reason not to be there. Everybody else is.
So we are there because it's as good of a place as any, and our business is very dispersed. We have 160 locations in over 30 countries, more than 60 manufacturing sites. And so my job is to make sure that our folks are working on the right things with the right incentives. And so I'm traveling as chief cheerleader to visit our people all over the world most of my time, and coming home to Florida isn't such a bad thing.
That's not a bad thing. It's a publicly traded company. ESI is the ticker. For those playing at home, it's up, I guess it's got a market cap of about $5.25 billion on a trailing 12-month basis, up about 2%, year-to-date off about 6%. What's the message you bring to your shareholders? You're in New York. I'm sure you're seeing some shareholders as well. What's the message for your company?
So this business has come off of a difficult demand environment in 2023. Electronics markets drew down significantly. The global industrial economy stuttered a little bit. And as we enter 2024, we managed 23 well, preserved profits, made some great capital allocation decisions to position the business well for growth, and our end markets are getting better. Semiconductor markets are improving, electronics markets are improving, and so we're well positioned for several years here of above cycle average growth.
Huh. Is that an inventory thing, or is it an end user demand thing? Are we just restocking inventory at this point?
It's an end user demand thing. We did have a drawdown of channel inventories post-COVID. There was a bullwhip effect. Electronics were overbought by the supply chain in 2021 into 2022. There was a big inventory clearance in 2023, and now we're starting to see semiconductor production increase. We're starting to see new smartphone models gaining traction. Our story is not just one of units. It's content per unit. And so the more technically challenging, the more robust the application, the more value for a company like ours. And so we're going to grow over and above units through the cycle. And unit growth is poised to recover nicely here.
So I'm just looking at the FA function on the Bloomberg Terminal Financial Analysis. It looks like the street's got kind of mid-single digit kind of revenue growth over the next several years, mid-teens EPS growth, so some operating leverage in your business model. Is that what you're telling investors to buy, or